And let's not ignore the empowerment element of our professional team. I can tell you they are there. I think we are getting there. Nonhlanhla, we didn't hear you yesterday. You know your social housing, you have got a finite beneficiaries. Those that earn between 1,850 to 22,000. So it doesn't mean that anyone qualifies. You also need to do screening of those tenants. Because the worst thing that you want is to fill your building with tenants that are not going to pay. Or tenants that are even blacklisted. So despite the fact that you have got that band of 1,850 to 22,000, you need to screen your tenants. Make sure that at the end of the day, you've got tenants that are going to pay you, and also more importantly, your property management. If you ignore your property management, that's for disaster. Remember what we said. Property management, tenant management is the lifeblood, is the key, is the hallmark for the property development process. If you don't manage,
it would be a snapshot at year end.
Okay.
Of assets and liabilities and the balancing of the two. The income statement is basically it has non-cash items, your depreciation, income in, operating expenses, and so forth.
Okay.
So that's the comprehensive income of the company. The other one is the position of the business as at year end.
What you just said. And so, to take from what he said, an income statement is essentially a record of everything that's happened in the business over a specific period, whether it's 3 months, 6 months, or 12 months. So it's a summary of everything that's happened, how the money came in, how the money was spent. A financial statement is a snapshot of the, call it the health of the business at a point in time. And let's remember that an income statement is a summary over a period, whereas a balance sheet is a snapshot of the health of the business at a point in time. So let's start off with, if we were looking at the income statement, which is a summary of how the money comes in and how it's spent, would we agree that money coming in is income? I've got the definition there on the screen. It's the sum of all profits, interest payments, rents, other forms of earnings. So how we earn money. You might have heard the word revenue, income. What is that? That's all money coming in. So if we're in the business of rental accommodation, how do we make money? I'm specifically going to start at the back. Ben, how do we make money? Rental income. What is rental income? Rental that tenants pay to occupy the unit. So the formal definition is, it's the money you earn that in exchange for the use and occupation of what? The four walls. Right? Because when we're renting out to tenants, we're giving them use and occupation of four walls of the space. Would you agree then that the lease is, the fancy English word is, it's a reciprocal agreement? We give the tenant use and occupation. In exchange, the tenant gives us rental. And it's an agreement. So if one of us is not performing, we're in breach, and that's when we go into the stuff that Henry talked about yesterday, rental housing tribunals, and worst case is evictions. But if we're saying that money comes in as rental, And our core business is residential. So it's the 4 spaces that people live in. What else could be rental in a social housing project? Remembering we said it's the use and occupation. So where else could we get money?
Morning. I think you could also receive money from services, non-GLA income, depending on where or how you set up. So a lot of residential developers are not looking at your billboards for surplus cash,
Yes.
which I think is undervalued in terms of that non-rentable space, as it were.
Yes. So we heard what he said. He said we can earn income from other services, and he used a very industry term there, non-GLA. What he's saying is non-gross lettable area income. So I'm going to put that aside for a little bit, and I'll come back to that, because when you say non-GLA, the GLA is the rentable space, which is the 4 walls. But there's other spaces in a building that's not the 4 walls. There's the what we call the facade, the face of the building. And he talked about the billboards. So if you have a billboard on your building, that's non-GLA income, because it's not necessarily space that people use and operate in. But there's other spaces that people use and operate. Parking, I like that. We're skipping ahead, but I like that. But why would parking, okay, let's say, when would parking be income? And let's give a clue. So if you've got a building here in Midrand, it's an estate, and for every flat, there's 2 parking bays plus visitors. Versus Pretoria CBD, Henry talked about yesterday the parking ratios for social housing. We try to get them to 0.3 parking bays per flat, but normally it's 0.5. So would you agree then, if that's the ratio, it means that you don't have enough parking bays for everybody in the building? So in which one would we be able to charge for parking? The Midrand one or the Pretoria CBD? Pretoria CBD. Why? There's not enough. The economic term is scarcity. It's a scarce item. More people want it, therefore we potentially can charge rental for it. But if you've got a complex that has a lot of parking bays, some will charge rental, but for the most part, it's not so easy to charge rent for parking in big estates with lots of parking. There's an easy one. What about shops? Shops? A creche, yes. A gym, right? A computer center. Yesterday, Henry said that we're moving into the new era now, 4th industrial revolution, where people want what? Wi-Fi. Wi-Fi? What do we think? Do we actually think now we can charge for Wi-Fi and make money off it, or is it something you got to just give in the building as a value add? We charge. Okay? It depends. Actually depends. So what you're seeing a lot of buildings are doing now is they'll get a bulk Wi-Fi provider who then gives each unit, say maybe 10 megabits up, 10 meg up, 10 down, and maybe charges the tenants 100 or 150 rand a month. So it's actually in a big building, it's cheaper than for us if you're living in an individual house where I think Vox is what, 500 rand, 600 rand. So that's where the market is going. What about those cell phone towers, cell phone masts on your roof? So those are all different types of additional income. And typically what we say is, if it's for 4 walls, like shops, creche, gyms, it's still GLA, so it's just other income. But if it's for stuff that typically isn't around 4 walls, we call it non-GLA income. But all of it is under this umbrella of other sources of income. So there we've touched on what the rental income is. It's the money that's generated in exchange for the use and occupation of the building. And we've touched on that even in a social housing building, you can have commercial sources of income. To break away for a little bit there, so one thing to remember, if you're doing a project that is mixed use. It has residential and commercial. If it's funded by the SHRA, the SHRA's grant can only fund residential uses. What did we say the grant quantum is? It's 328,687. So that 328,687 can only be used to fund the residential portion of the building. So what happens if you've got a 10-story building, you've got 800 units, and you've got 10 shops on the ground floor? What do you do there? So in your application, it's actually going to be two versions of the QuickScan C. One version shows only the residential, one version shows everything. The version that will get approved and that you'll sign your grant on will be the version with only the residential. So it's a little nuance to remember that the social housing grant can only fund residential uses. So then where would the money for the shops come from? Let's think through yesterday what Henry was talking about. He said that when you put a project together, you fund it with the grant, with debt, and equity. So we agree then that the shops, whatever the cost of that ground floor is, would come from your equity and your debt portion. Okay. So, parking. We talked a bit about what parking is. It can be a source of income, but it depends on the market and it depends on the location of your building. Vacant. I won't go through the definition because Henry touched on it yesterday. Maybe a simpler way to think about vacancy is it's the opportunity cost of having a space empty. An old mentor of mine said that the problem with vacancy is when you have a unit vacant, that money is gone. There's nothing you can do to say, hey, we need an intervention to recover. It's gone. So a vacancy is like, it's a disease in property. You don't want it because there's no way to recover that money. And essentially what we have is we have what we call short-term vacancy and we have long-term vacancy. When you finish a building, and let's say you've just bought the building and your program is 9 months to refurbish it, when do you think you must start marketing? And why is it important to start marketing early? At the very beginning of the project. That's a very good idea. But maybe to take it further, the SHRA will actually now want you to start marketing at least 6 months before practical completion. Why is that important? Exactly. It's because when you finish a project, there's a period called a lease up. From when you finished and you've got your occupancy certificate, people can move in. Now you're marketing and you're trying to get people into the flats. Your vacancy then is going to be very high. So short-term vacancy can be anything from 20 to 40% for at least 6 months. But then afterwards, as the building gets full, and maybe after 2 years, you hit what we call long-term vacancy. And what we've seen actually is, I'll go through an illustration now of the SHRA rentals. But if you think about the fact that in your income bands, you've got income band 1, where the rentals can be around 700 to 900. Income band 2 can be around 1.5, and 3 is around 2,700. Would we agree then that when you finish your building, there will be a lot of demand for that because it's competitively priced? Those are the truly subsidized units. But then your income band 4s, now with the change in rentals, it's an average rental of 4,300, and income band 5 is 6,005. How do you think how quickly are you going to let those units? Might be a bit slower, because obviously they're less subsidized, and you're competing with the broader affordable housing market now. Because I think there's a lot of buildings that are offering rentals. You see them all around, starting 5,000, starting 6,000. You are competing with those people for income band 5. So that's why it's important to understand that there's short-term vacancy, and it's important to manage that while you're building. So you've got to have a marketing strategy while you're still building to actually get people awareness. And actually, with that strategy, are you marketing income bands 1, 3, or are you actually marketing 4 and 5? Agreed. And then long-term vacancy, that's the one that we read about in the news, in the press, property news. Maybe give us evidence as to what typically the vacancy is on a big residential property. So no, we're not talking about individual houses. We're talking about block flats. What do we think is the percentage vacancy? 8, 9%. That's okay. Why would you say that? Just the market. Okay. So historically, that's been, the number has actually historically been closer to 8 to 9%. And that comes from research from a report called the ODA Report. Has anyone ever heard of that? The ODA Report. So it's a publication that comes out quarterly, and it gives data on the whole property market. So I'm going to show you that. That's an extract from the ODA Report. This one is a bit outdated. It was quarter 2 of 2022, so that would be up to June last year. And what that's showing you there is flat vacancies, but this is all types of flats. So social housing, affordable housing. It would probably also include student accommodation, also include upmarket rentals, so anything 10,000 and above. And you can see that it's showing that Johannesburg, quarter 1 was 12.7, and then quarter 2 was 10.1%. So that's saying on average, the buildings have a vacancy of 10.1%. What would affect this vacancy levels? What drives it? Okay, I heard an interesting one. Safety, okay. Building upkeep. So those are all at the building level. But if we're talking at the economic, what they call the macro level, for everybody, would we agree that factors in the economy drive vacancies? So affordability, so people's wages, how much income they're earning. I guess this whole issue with inflation, because inflation makes everything expensive. So those are the factors that would typically drive affordability. And you can see that Gauteng, as a province, in quarter 2 was at 9.8. So you were very, very, very close. Another example I wanted to give here. This is, who's heard of the TPN report? TPN. So this is a service. It's paid, but most of the data you can actually get for free. But they do research, but they also do data for rent collections, rent payments, and then they put together these reports like this one's called the Residential Rental Monitor. Comes out on a quarterly basis, Henry? Yes. So let's focus on this table here on the right, on my right-hand side, on your right-hand side. What they've got here is flat averages by different rental bands. So flats under 3,000, flats between 3,000 to 7,000, 7,000 to 12, and so on. So would you agree that our market as social housing, where Henry said the average rentals was 3,337, probably sits in between these two brackets here? And the way it's color-coded is that this green section here is the good standing. So they look at the whole market in that segment and say, on average, our tenants, how many tenants are paying their rent on time? So for example, within 7 days or within 30 days, whatever the measure is. And then at the top there is the vacancy rate, which is, we've just talked about the vacancy. So we said that for Johannesburg, it was at 10.1% across the whole market. But look at that. For a comparative affordable housing segment, it was about 7.61%. Then there's another measure there called escalation. Let's just keep that in mind there, that escalation of 2.3% for the affordable / social housing market. So, we said keep that measure in mind, escalation. What do we understand by escalation? It's on the screen, annualized increase in rental rates. But let's talk basic terms. What is escalation? Yes. That's exactly what it is. But why? Cost. Okay. What's inflation? Yes. 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 So it's the relative change in the prices of goods. Differently, it's the relative change in the purchasing power of money. So if I have 10 rand, Amanda. Sis Amanda gives me 10 rand today. I've got two options. I can go put it in the bank or invest it, or I can put it under my mattress. Who decides to put it under his mattress, I put it in the bank. 12 months' time, inflation's at 7%. Who can do the maths for us? So inflation is 7%. Let's assume that inflation was 7%, and if you invested, the bank would pay you 7%. Very unlikely, but let's assume. Let's assume it was fair like that. That you could invest, A, you can invest 10 rand, earn 7% after 12 months. B, you put it under your mattress. Who's better off? Would we agree that if inflation is 7%, it means that the value of 10 rand after 12 months has decreased by 7%. So the purchasing power of that 10 rand has lost value by 10 rand. So what do you need to do? You need to invest it so that it keeps up with the relative changes in the prices of goods. So can we agree that this thing of money under the mattress doesn't make sense? There's no world where you can, it's a good idea, unless maybe if you're, okay. Yeah. Right. So, Amanda said that we need to pass that on to our tenants. So, where did inflation print now recently? I think it was 7.1 or 7.2. Then 7.25. Okay, so that's where inflation is now. But what did that number that I said let's keep in our minds, what was it? That escalation, what was it? 2.3. What's happening? Escalations on average for our market, that's what's important about that page. It's showing you escalations in the affordable housing space. Not the whole market, our space. 2.3%. But inflation is 7. So, but what's happening here? So it means that landlords or property owners are not able to increase rents at or above inflation. So what's driving that? Affordability. So, unfortunately, it's not always the case that you will be able to escalate your rentals at inflation. It should be a target so that you can maintain what the value of the purchasing power of your money, the value of your 10 rand. But, So more and more people will be forced to maybe look for different ways or different alternatives. So you're going to get hit with a double whammy. You're not escalating enough, and your vacancies are increasing. So in that scenario, it would typically, remember that your debt service cover ratio, what is that formula? It's your net income divided by the sum of your total payments on your debt, both interest and principal. But every year, as you pay your debt, what happens? The debt goes down. So if things are okay, even if you weren't escalating, what's going to happen? Your net income would stay flat, but because you're paying down your debt, it's going down, so your debt service cover ratio does that. It grows. It would go from 1.3 to 1.4. Yanda?
Yeah, I just want to ask, what's stopping property owners from increasing rent in line with inflation? So if why can't you keep it in your increase by to 7%? Why must you keep it at 2.3? You know.
That's why I said these two work together. Vacancy and escalation, they're a married couple.
Yes.
So if the economy is tough and you are increasing your rents by 7%, but Henry next door is only increasing by 4%, what's going to happen? They'll vote with their feet. So, I mean, it's not a hard science. And it's really, it's actually managing that escalation. I hope I don't upset anybody, but if in property, the only landowners were sort of big corporates, professional investors, then they would all escalate because they would all agree that, you know what, inflation erodes the value of our money, we must escalate. Then everybody would escalate, then people can't vote with their feet. But unfortunately, if the building here is owned by Sanlam, and Sanlam escalates by 7%, and I'm next door, I've got the same building, the same offering, I'm a private landlord, I don't report to big shareholders, and I decide I'm only going to escalate by 3%. There's nothing you can do. And that's the market. That's the market. So that's what I'm saying. It's not a science, it's an art. So but I think as developers, as property managers, as property investors, example we gave around 10 Rand today cannot buy what goods worth 10 Rand in 12 months' time. That's very important to understand. Exactly.
Because the opportunity cost was that you lose the tenant completely because you understood that the economy was at a disadvantage for everybody.
Okay.
So it wasn't even escalation.
Yes.
It was literally giving discounts.
Exactly.
And then now that we're starting to be back on, you are grateful you gave a discount to your tenants because you were able to still maintain your vacancies at a high level.
Exactly. Because why? At the end of the day, whether your building is empty or not, what are the things that you must still pay? Rates, insurance, basic upkeep. So you need to have income in your building. You can't just have a building that's empty. Okay, so we're comfortable on what escalation is. It's the annual increase in your rent to fight against inflation, but it must be balanced against affordability. You have to balance against affordability. Then recovery of operating costs.
Are you treating it differently because on construction the rules would be very different?
Yes.
In terms of calculating
Yes.
escalations?
Yes.
Can you maybe then just explain to us so that we don't treat it the same because when you are going to construct as an SHI, you would be impacted by escalations on if your construction would exceed 12 months.
Yes.
Yeah.
Yes. Okay, so let's zoom out. He's asking about escalations on constructions as against escalations on your rentals. Escalation on rentals is when the building is up. and we are operating. So that's escalations on your leases. That's a separate thing. But all linked to inflation as measured by this thing called CPI, Consumer Price Index. Okay? We've heard when Lesitja is making our lives difficult, he's always, the CPI. So that's CPI. Now you've got construction escalation. So that's how you budget for the change in the cost of construction during, one, your planning period, and two, during your construction period. You'd have, and the QSs can help me out here, but you've got pre-tender escalation and post-tender escalation. When the QSs are planning a project, they will estimate for that construction escalation upfront. Even if you're going to enter into a contract with your construction manager that it's fixed price. So for an example, I enter into a contract with you, you are WBHO. I say to you, we're going to have a fixed price contract. However, when we are planning our project, me and the QS, we are going to have a provision for the fact that we're planning today, it's Feb. We'll probably only get this approval in 12 months' time. We'll only start construction in 15 months' time, and we're going to build for 12 months. So that period where before we hit the ground is pre-tender. That period where we're building is post-tender. And the QSs actually estimate for that. And what then you do is that estimate has to be balanced against when your contractor submits their bid. Even if it's a fixed price contract, the contractor has already factored the fact in that he's going to be building for 12 months. Every January, February, steel prices jump up like crazy. All of that is built in. However, if it's a fixed price contract, whatever you sign on is a fixed price contract. Unless you as the developer come and do changes, then it's variation orders and stuff. But, so let's talk about that pre-tender and post-tender. Those calculations are done, it's a formula called the Highlight formula, and it benchmarks off the Bureau of Economic Research Estimates at Stellenbosch. So they take out an index, which is still linked to CPI, but obviously factored in for the weighting of construction goods. So do we kind of see how, think about CPI as a basket of all things in the economy, energy, food prices, bread, milk, and then you create this basket, and they look at how those prices change, whereas the Bureau of Economic Research does a similar thing. However, the weighting is more around elements that affect construction, I guess cement, any minerals, what else Henry would go into BRs. But I think you get the point. So all of that is factored into, one, how your QS estimates that escalation factor, linked, and they use data from BER, whereas what we're talking about here is escalation on your rental leases. So wait, recovery of operating costs. Would we agree that if you're operating, you're the property manager, you've got your tenants, electricity, who pays for that? Tenants. Water? Trick question. Sewer? Who pays for sewer? The property? Pay on behalf of tenants. It's a trick question, but it's actually it's a very important question, especially in Johannesburg. Because in the past, sewerage used to be billed as a factor of water. So if I use 10,000 liters of water, sewerage would be, let's say, 5% of that. So if I'm a tenant and I'm paying for water, I don't see it, because the landlord's going to bill me 10,000, call it liters, plus 10,500 as an example. So I just see it as one big water bill. But now the municipalities are starting to bill fixed charges for blocks of flats. City of Joburg now charges 275 Rand for sewer per unit. And it's a problem now because tenants will say, but I wasn't in my flat for 2 months. Why am I paying you 600 Rand? but it's a fixed charge that the municipality is passing on to landlords. I'm sure you've seen on Twitter, there have been people who've been complaining and, saying they're going to take CEO of Joburg to court. And I think actually Johannesburg property owners, J. Poma, they've got a case pending with City of Joburg about that. So sewer is something we need to think about, because in the past, landlords also maybe used to swallow that cost. But you can imagine if you've got 1,000 units, 275 per unit, that's R250,000. Can you swallow that? So it's a recovery. Let's talk a little bit about electricity. Do you recover all the electricity, or what about electricity in your passages, to your security gate? Actually, that's a better example that we've seen recently. If you've got a block of flats and you've got a lift, you have to have a generator. There's no getting around it. But now imagine those big buildings in the Joburg CBD, the size of that generator. How much diesel it uses. How much diesel did it use during stage 6? This was a serious thing. Who pays for that? Can you pass it on to the tenants? It's a great question, a great response. If you're only getting 2.3% escalation, how are you going to pass it on to the tenants? So once again, it's this balancing act of affordability versus profitability. Okay? So, in summary, operating costs that we recover, the easiest way to think about it is what the tenants use in their 4 walls is for their consumption and their expense. Outside of the 4 walls is for you, the property owner. Easiest way. But once again, it's an art. It's not a science. Operating income. I want to spend a little bit of time here. Who can give me, I did this calculation with someone yesterday. Remember Henry was talking about how you value a building, where you've got net operating income, and then you've got a cap rate, and then you divide the net operating income by the cap rate, and it gives you the value of the building. Who remembers that number yesterday? It was like 24.5 million odd. Okay? So what did we use? We said net operating income divided by a cap rate, or maybe you want to say a valuation rate, gives you the value of the building. So what is net operating income? The accounting and financial managers have very fancy words for this. There's EBITDA, earnings before interest, tax, depreciation. But net operating income is the difference between gross rental, otherwise called revenue, less what you spend to run the building. So direct operating costs, I'm going to get into that now, and overheads. Some would say fixed costs, but I don't like that term because it can be quite misleading. But it's essentially, where do we get our money? From rentals. That's our revenue. Then we must upkeep the building. We must pay for electricity, we must pay our bulk account, rates and taxes, we must pay for cleaning, we must pay for insurance. Those are direct operating costs. Fixed costs are overheads, which is if Khomotso works in this building, Henry said he qualifies as in the beneficiaries, so he has to earn salary in that band. That's head office costs, salaries. It's not wages, it's salaries. What does that give you? That gives you operating income. But I'm sure if you've heard about income statements, there's more. After operating income, there's things like depreciation. There's interest payments on your debt. But you don't see that there. Why? Why? Kevin, what do you think? Okay, I won't do that. So we were saying operating income. Why do we use operating income and not net income? Because net income would say, after operating income, you'd have depreciation, you'd have interest payments, you might have tax. That would then give you net income, what's left over. Okay, guys, bear with me. We're nearly through this section. This is the slow section, but let's stay together. Are we together on operating income? Yes.
I would say because they are not regular costs or interest. It's something that doesn't come on a monthly basis,
Okay.
but could be covered by the contingencies. Is it contingencies?
Okay.
Contingencies, yes.
I like where you're going, but let's remember contingencies falls into the world, the budget for the project. We're still talking about now, we finished. We're not building, we're finished. It's operating, you've hit 100% occupancy, you're out of the danger zone. I like what you said in terms of it's because it's not always recurring, but maybe that's a bit too advanced because those are called non-recurring items. But in a normal income statement, you would have gross rentals, less vacancies, less direct, less overheads, you'd have operating income, then you'd have depreciation, then you'd have interest payments, then you'd have what you call net income. Then you'd have tax payments, then you'd say net income after tax. And that's what we would really care about because that's what you can pay yourself dividends with, right? But why is it that in our industry and in most businesses, they look at operating income instead of everything below operating income? So I'll give you an example. I buy a building, I buy it for 10 million. I don't have a rich uncle, so I need to go to Tough and say, Tough, I've only got 10% equity, I've only got 1 million. Can you borrow me 9 million? That 9 million is called gearing. The gearing is 9 divided by 10 is 90%. So I'm 90% geared, right? Henry has a very rich cousin who says, same thing, to buy the building next door, it's 10 million, but Henry can contribute 3 million to it. So he only needs to borrow how much? 7. So he's geared 70%. So let's think about that now. I'm paying interest on 9 million. He's paying interest on 7 million. Can we agree that the interest expense is going to look very different? Let's say interest rates were 10%. I would be paying 9 a year. He'd be paying 700,000 a year. It's the same building. We're right next to each other. They're twins. We're both occupied. We're both running it well. Can we agree that now all of a sudden we had twin buildings, but when you look at our income statements, you can't compare them? Because everything here, gross rental, the same. Vacancy, the same. Direct operating costs, the same. Overheads, the cost. Overhead costs, the same. Operating income, the same. Then all of a sudden you go below interest payments and it changes. Why? Because here's what we call capital structure. How he structured his capital is different. And that's always the case. Every business is going to have a different capital structure. Some businesses like to be overgeared because remember the interest payments that you pay on your debt, those are deductible for tax. Some businesses like that. Some businesses don't like debt. If you were a Shirai business, you wouldn't like the debt. So therefore, you would have more equity and your interest payments would be low. So can you compare, is that apples with apples? It's not. But what does operating income allow us to do? Allows us to assess, an apples for apples basis, how well management runs that building. Because if the two buildings are exactly the same, we have the same number of units, we're offering the same service. If I'm better at service delivery, if I give my tenants better service, I clean more, I've got Wi-Fi, what's going to happen in my building? I'll have better, lower vacancies. My vacancy will be less, which means I'm performing better. And I'll probably be able to have better escalations. So my gross rental will be better. If I'm better at managing the cleaning team and what it costs us to run the building, my direct operating costs will be better. And if my overhead, my office team is less bloated, I don't have 50 directors all earning 2 million, my overhead costs will be lower. So what is it showing you? It allows you to compare one operator with another operator. So if I'm investing in, if I've got these two buildings and I want to invest, then I can look and say, okay, this operating income is better for the same type of building, I'll invest in this one. Because I'm comparing apples with apples. So that's why when you do property valuations, everything is based on operating income. It's an apples for apples way of comparing similar buildings. But then Henry talked about that cap rate yesterday. Who remembers what a cap rate is? Stick with me, we're nearly through it. We're nearly through this. So let me give you two examples. If I'm an investor, there's two things I want to know. I want to invest in this building. I want to know what my return will be. So we call that an initial yield. And what that says is it's 1 year's operating income divided by the cost to build the project or to buy the building, whatever it is. Whether if you're buying something that's existing, it's the cost to buy it. If you development, it's the development cost. So it says, in this project, how much income am I going to earn for 1 year divided by the cost to buy it? We call that an initial yield. Same buildings. Remember we said these buildings are 10 million. Now let's say that building earns operating income of 1 million. What's the return? Who can help me? What I'm earning divided by the cost. Ben, can you help me? I'm earning 1 million. It cost me 10 million to buy it. What's my return? 10%. 1 divided by 10. 10%. Okay? So now, that's my building. Henry's building, we said it's the same. It's a twin. It earns 2 million, but it also costs 10. What's his return? 20%. Which one is better? That one. Do you see how now we can have apples with apples? Why it's important to focus on operating income. Whereas if we included the stuff afterwards, we wouldn't get a comparable measure. So that's called initial yield. Now, a cap rate that Henry talked about is the same thing. It's also net operating income divided by the value of the building. If a cap rate is not specific to one building. An initial yield will always be the yield on this building. So if I want to buy, for example, if I want to, here's a good example. If I want to buy the Sasol building in that new fancy one in Sandton, okay, then there's the Sasol building and there's the Discovery building. We all know those two buildings. Would we agree in quality, they're similar? In prestige, they're same? So if you're an investor, would you compare them as similar types of investments? Sasol building versus Discovery building. Probably Discovery is better, but it's a nicer building, right? So now I come to you and I say the Discovery building's initial yield is 10%. The Sasol building's initial yield is, but the market, when it looks at what we call prestige office buildings, so we call it P grade, the market cap rate for those types of buildings is 12%. What's happening here? So we said Sasol gave you an initial yield of 10. We said Discovery gave you an initial yield of 15%. But in the market, when people think about these prestige buildings, they use a cap rate of 12%. What's the difference? Who can help me? So what the thing to remember there is the market. An initial yield is is for a specific building. A cap rate is a market rate. So if I'm an investor, I don't have to necessarily know what the yield on a Cecil building is or a Discovery building. If I know that the market says those type of buildings should give you a return of 12%, then I can use that to value that building. Why is that important? When you want to buy a project in the Joburg CBD, and someone says to you that CBD residential has a cap rate of 15%, it means you can use that and use it to value any building that is one residential high density in the Joburg CBD with that cap rate. It doesn't mean though that when Ben did that development he earned 15%. He might have earned 20, he might have earned 10, but the market says those types of buildings in that area should give you that rate. So even though the formula is the same, it's operating income divided by cost. Cap rates are for the market. They tell you about the whole market for that type of property, whereas an initial yield is that specific property, that specific developer's return at that point in time. And the type, yes. Yes. Oh, sorry. Apologies.
Thank you. I thought my voice was deep enough. The type of building counts a lot, because if, let's say, you have flats that are 2 bedrooms and others have 1 bedrooms or the 3 bedrooms, the cap rate will not be the same. And if you make a mistake and say, because the cap rate that I was given is 10%, it might not be 10% on a certain type. Maybe the demand is not on the 2 bedrooms, it's on the 1 bedrooms.
Okay.
And that also has, it determines that cap rate as well.
Okay, I like that. Get into it, but I think what you're saying is the type of affects the cap rate. That's correct.
Different types of properties in terms of 2-bedroom, 1-bedroom would have a different cap rate. So would we be getting it from the RODA report or the TNPAs?
Yes, correct.
Okay.
So
Thank you.
RODA report, I can show you to, it might take a bit of time now, but RODA publishes cap rates by type and by area. So we say Johannesburg, Ekurhuleni, Rand, West Rand, etc. Just to clear up, when we say in residential, it's not necessarily that you would have a cap rate for buildings with different types of unit occupancy. It would typically be defined by the density. So it would say high density, medium density, low density. You know, are you looking at buildings with 10 units, buildings with 200, buildings with 1,500? That's where the differentiation would be. Whether it's 1-bed studios wouldn't really matter. It's the density. Okay, how are we feeling about operating income? Are we okay with it? Please remember it, because it is the most important, I don't want to use a fancy word like metric, it's the most important line item for today. We're going to use it for the rest of the day. So operating income, it's what you earn, less your opportunity cost of space not let, vacancy, less your operating costs, direct and overheads. Okay? So, talked a little bit about what those operating costs were. We've discussed some of them. So if we say direct operating costs, it's normally costs incurred at the property level. Overheads, costs incurred at the business level. So you own a property company, you've got 5 buildings. Direct operating costs are the costs at each of those individual buildings. Cleaning, insurance, rates and taxes for each individual building, but obviously you sum them up. Overheads are costs for running your building, your office rental if you have an office, your management salaries. Do we see that difference? Trick question. Rates and taxes, what's that? Direct. Okay, let's follow that logic. So sometimes they say direct operating costs are based on the rate of use of the building. So if the building is empty, you're still going to pay rates and taxes. So is it overheads or direct? Still direct, because it's at the property level. So you are right. We happy with that? Stationery. Typically overhead, but it can depend. You might have a site office, then it's direct. So do we see the difference? Anything at the property, direct. Anything to run the business, overheads. Okay. Now, something to remember. When you're doing a quick scan C, every time you do a project, you have to do a new quick scan C. Quick scan C only talks to one project. So even if you are an SHI that's got 10 buildings, when you do your 11th building, you have to do a quick scan C. That quick scan C talks to building number 11. Doesn't talk to all other buildings. So when we say you only include the incremental costs, you can imagine that if you're an SHI and you've got 10 buildings, you've got quite a lot of salaries at head office. You've got a financial manager, you've got a legal director, but you're not going to include all those salaries in Project 11 because they've already been covered in the first few projects. So it's the incremental. I'm getting faces that don't agree. Are we agreeing? Okay. Right. So they helped us with it. So now we finish with the income statement. Now we move to balance sheet. So now we're saying, what is a balance sheet? Definition on the screen, but essentially, sheet is a financial statement that shows the health of a business. It shows you what does the business own, the assets, what it owns, i.e. what you've invested in. Now, the assets that you own, how do you get them? You get them through capital. Either money that you borrow. Remember that example we did of, I buy a property for 10 million. How do I buy it? I use debt and I use equity. That's the capital. So the balance sheet shows you, one, the assets that you own. Two, how you've structured your capital. Where did you get the money to create those assets? What did you borrow in terms of debt? And how much equity did you raise in terms of equity? But then under equity is also basically every year from your income statement, we go back here and we said we have gross rentals, we get to operating income, we pay our interest, we have net income. We pay our tax, then we have free cash flow, distributable income. If we don't distribute it, where does it go? It goes to equity now because it's money that we own. We've made money. And then that goes to equity. So the balance sheet is a summary of all the assets that you own, less the liabilities, and the difference between those two is owner's equity. So equity. Who remembers that formula from school? You remember that one? Let's play around with it a little bit. So it says O equals A minus L. Take the L to the other side. What does it say? A equals O plus L. Your assets, what you own, equals the liabilities, the money that you borrowed to create those assets, plus equity, the money that you invested to create those assets. Agreed? So who's heard the term capital employed? Sometimes in a balance sheet they use that. So So that's what it is. It's you have the capital. How did you employ it? Employed it to create the assets. So how well you used your assets, your capital results in that formula there. Now, yesterday, Henry talked about that land can be equity. Let's look at an example. But he said it must be unencumbered equity. Who remembers that? Remember that? Okay. Is that visible? Can everybody see that example? Okay. So, back to this example again. Building purchase price is 10 million. Company A has a gearing of 70%. Company B has a gearing of 80%. So therefore, they've borrowed 8 million versus the other guys who've borrowed 7. Therefore, the equity is 2 versus 3. Who can, just so we understand this, I want to make sure we understand this properly. Who can relate this to that slide that we were just talking about? O equals A minus L. Who can give me an easy way to translate that into this spreadsheet? Yes, of 10 million. Correct. So the gearing is the percentage of the debt of the asset, but the O would be the equity. So are we together on that? That's all it is. It's as simple as that. Now, what? Okay. But the formula was O equals A minus L. So what is the A? What is the value? 10 million. What is the L? The 8 million. And what's left? Would we be in business if we did this today and in 5 years' time the A was still 10 million? Would we be in business? No. We want growth. We want capital growth. Right? So we escalate our rents every month. We perform better. Then the value of the asset grows. So let's look at an example of what happens in 5 years' time. Okay, can we all see that? So what we said there was the building valuation. It was 10. Assume that the building grows in value by 5%. I think Henry talked about those years of 2004. Back then, values would grow by 8 to 10%. But since around 2009, capital growth has been around what, Henry? 2 to 4, plus minus. So it's less than inflation, capital growth. So let's say it grows by 5%. So I won't go into the formula on how we calculated that, but it's just saying if your present values, if the value today is 10 and you grow at 5% every year, in 5 years, your asset has grown to 12 million. Are we okay with that? We've just used the normal future value formula. Now, who's ever seen a term sheet from your banks or your standard banks? And you would have seen that they will normally say, if you've got a 5-year loan, the value of the loan in 5 years has a residual value of 60%. Anyone ever seen that? Have you seen that? A lot of term sheets have that, right? What it means is if you borrow 8 million today, all your repayments, it means that at the end of 5 years, the value of that you would have paid off 40%, so there'll be 60% outstanding. Okay? That's after 5 years. So that's the calculation we've done there. We've said debt outstanding, 60% of the balance here. So 60% of 7 would be the 4.2. 60% of the 8 is the 4.8. Are we together? because you've been paying every month. You've been paying your interest and your principal. Now what happens? Who can help me understand how we get to that number of equity now? Remember we said O equals A minus L. I'm waiting for it. Guys, I'm waiting for it. I'm waiting for it. Because the room should start getting excited now. What's happening? The loan. So I can end the presentation because that's the power of property, no? You own the asset, you manage it well, the value goes up, your debt goes down. Look, it's your equity. You started with equity of 2 million. Where's your equity now? 7.9.
Sorry. I just wanted to ask, I mean, for the past 2 years or 1 year, interest rates have been going up. So surely, depending on your term sheet, whether you're having a fixed interest rate or you're having an interest rate that's linked to the prime, that does something to your balance sheet and to your equity.
Well, the interest, remember that the banks, if we're not talking about element banks here, we're talking about normal banks. Normally, they would look at the debt service cover ratio, which is your net income, your operating income, divided by the total of your interest payments plus your principal payments. And when they look at it, they need to basically make sure that your debt service cover ratio, i.e. your ability of your building to service the debt, can withstand shocks. So hence why we have that number of 1.3. Because essentially what it's doing is it's saying you have enough money that if interest rates go a little bit up and your interest payments go up, you're still able to make those payments with that amount of income. So are you hearing what I'm saying? But let's say if everything you've done properly and you've got a debt service cover ratio of 1.3, interest rates have gone up, they have by, call it 2%. What happens now if they shoot up to 15%? Then your debt service cover ratio is going to get blown up, right? So then all of a sudden you don't have enough money to service the interest and the principal on your debt. What's the bank going to do? You have to restructure. The bank's not going to give that money away. They're going to come back and say, okay, well, let's restructure this facility. Either we're going to make it slightly longer so that your payments go down, or we're going to give you what they call a slight moratorium on capital, but you must still pay your principal, and that's when it starts to hurt your balance sheet. Because what does that mean? It means that your balance outstanding goes up. So maybe if for the next 2 years interest rates keep shooting and shooting and shooting, you're going to have to capitalize more and more of your debt. You might not end up at 60%, maybe you only end up at 75%. Therefore, the equity that's been created is less. But I can believe you, if you're in that scenario, the bank's not going to let you touch that equity. They won't let you, because you're in breach. You've breached your debt, what they call the debt covenant, your marriage contract with the bank. Okay, so let's talk about assuming things are going well. This is the power of property, that your assets, if you run them well, they grow in value. If you honor your debt and you pay your debt goes down. In this scenario, we invested 2 million. Our equity after 5 years has grown to 7.9. We can refinance and take out almost 6 million, but we still own the building. We didn't sell the building.
And that's the power of leverage or gearing.
I thought everyone would be excited to, that is the power of, you don't have to sell your building, you can restructure, release equity, but this all depends on how you manage your building and how you manage your debt.
All right, so from the balance sheet point, I put in 2 million.
Yeah.
My equity is now 6. That's almost 300% return.
That's why
I put in 3. more money, the return is about what, less than
Yes.
200.
Yes. That's
So
the
the less
power.
money you put in, the more money you make.
That's debt, that's leverage. That's the power of leverage.
That,
From an operating point, though, your repayments are higher on the 2 million than the 3 million.
Correct, correct. So that's the impact on your income statement is harsher on the higher leverage scenario, but the value creation on capital on leverage is more amplified. You'd have to run that model for yourself to say how much, and remember going back to what drives that is, net operating income. That operating income drives it. So how much debt can you raise so that you can still meet your debt service cover ratio of 1.3? That's actually what would drive that number. And ideally, you want to have a debt service cover ratio of maybe 1.4, so you've really got a lot of wiggle room, especially given where we are in the cycle.
and this is why you often hear people saying you need to use other people's money.
This is other people's money. That's what this is showing. Here you used less of your money, you made more. But what are we not saying here that's very important? Because I don't want you to walk away saying, dai bra khomozo. Ben? Yeah. No, only 5%. So I can show you the formula. I mean, we can't get into the maths of it now, but
Over 5 years, sorry.
yeah.
I calculated it over 5 years, and I'm getting 500,000 using the 5%.
Yes, so you using the simple interest.
Yeah.
This is what we call compound
Compound.
interest.
Okay.
Interest on interest. So you see the formula there. It's the present value times 1 plus the growth rate
And
over
the
5
fi-
years. So it's 5% year 1, 5% year 2, 5% year 3, interest on interest.
Okay. Cool.
All right. So main thing we're not talking about here is risk.
Oh, well, I think you are about to touch on the risk
Yeah.
side, so let me not.
Yeah. Risk. Leverage creates risk. So building A, geared 80%, building B, geared 70%. Let's say the one had a debt service cover ratio of, let's say this one had 1.3, let's say this one had 1.5, because he's geared less, right? The buildings are identical, the net operating income is the same. They're both making 1 million, both making 1 million. COVID hits. Vacancies, during COVID, vacancies shot up in residential to about 16%. Do you think if the average vacancy for the last 10 years was 8 to 9%, when the risk guys and the actuaries were doing their numbers, do you think they would have pushed it to 16%? They would have probably gone to 13, 12, COVID hits, boom. So can I just finish this point? COVID hits, vacancies shoot up. What does vacancy do? It affects your operating income. It takes it down. Talks to your question. Now all of a sudden you can't service the debt. Who's going to hit trouble faster? This one. Because they've got a lower debt service cover ratio. They're at 1.3. They're going to hit 1.11 a lot faster than them because they're at 1.5. So debt introduces risk into your structure. Do you want to add to that? Yes. Yes. Yes.
Which a lot of the companies found to be the case.
So he's saying that the listed companies, the listed property companies, the REITs, real estate investment trusts, a lot of them have run into trouble because when times were good, they increased their borrowings, their debt. But then all of a sudden the economy hit a speed wobble, and all of a sudden they can't service well, they've got a leverage problem. But let's unpack it a bit more, because so you know why REITs came about?
Maybe just to talk about that. If you look at your REITs, all what they do is they don't service capital. They only service interest. So all their facilities, if you look at all the REITs, they only service interest. And what they do is the funders who look at basically, they look at the company. This is a growth point. This is a redefine. This is a high prop. And they look at the liquidity. So you find that although they might have that sort of situation, they are not being compelled to pay off that debt. All what they have to do is to ensure that they continue to service that interest-only facility. And a lot of those REITs as well is that they hedge their exposure. So in other words, what they'll do is they'll fix their interest rate. So they have a hedging strategy of saying, you know what, we are going to have 50% of our debt hedged for 5 years. We have another 30% hedged for 2 years, and then we have 20% that is floating. So that is also another way of mitigating that interest rate risk exposure.
So agreed. So we agree then that even though other people's money can make you money, can also wipe you out.
Yeah.
So we're comparing apples with apples. So we're assuming that you have 3 million, and the decision you're trying to make as a SHI or an ODA is, do I put 3 million or 2 million? From a numbers point, if you put 2 million, you're better off, because even from an EBITDA on the operating side, you're paying less tax because the operating costs are higher, but you still have 1 million in the bank account to cover you for the rainy season. So I don't understand when she's saying there's a risk factor on the 2 million side, but it's covered by the 1 million you have in the bank. Just
So
make me understand. Yeah, so I mean, I guess we're looking apples to apples. So 3 million, the decision I want to make is, do I put 2 million down at 1.3, or do I put 3 million down at 1.5?
So let me actually think about, I want to try and see if I understand the question. So you're saying, as an SHI, it's better to, as an investor. But remembering that the benefits of tax come at the bottom of, they call it below the line. So your tax treatment doesn't change the fact that you still have to service your debt. So if you run into a debt service cover ratio problem, whether you get tax benefits material, if you can't pay your debt, you're in default. So the issue is, that's assuming that you have them. Actually, the way to answer this is the IRR. Can we get to the IRR and then talk about that? Because IRR talks about you as an investor, what you've put in and what you've earned on that capital over time. Okay. Yes. Or later, yeah.
Yeah, thank you. Kumuzo, yes, we see the value appreciates in 5 years. Where is it? Oh, yes. But this is not a spin-off that an SHI can derive. Because remember, it doesn't matter what the value of the building becomes or the asset. You are still working, SHIs or SHRA does not work in the normal course of business of the economy. Mm-hmm. You have your 2.3%. So the only value to be derived from this is what? You can't even sell this business, even if you think it has tripled in value.
Yes.
So it only exposes you to what? To credit worthiness, maybe.
Yes.
Oh, okay. Thank you.
So answer this like this. The aim for SHIs is over time as they grow to become more sustainable. And we talked yesterday about why is it that SHIs often hit problems? Is because they don't have equity. They aren't able to raise equity. And they have to rely purely on debt. The idea would be that if you've got 10 buildings, after 5 years, you're starting to generate equity. Not only equity from the rental that you've been collecting after tax, because that sits on your income statement, but also as you start to refinance your existing buildings, this equity goes to the next project. And now that next project, you've got equity to put plus debt. So it becomes easier to raise and grow and grow and grow. So you're able to employ the capital better.
So you're saying, even though I can't sell it, but SHRA will recognize it as an asset when I do the next SHRA project.
Remember what happens physically. And this goes to that whole question around land as to, do I have to go and sell in terms of, I think there was a question where there was land and then a project on this side. You can't use it as collateral. But, so collateral means something that you come and you say, I want to do X, but I've got collateral as X to give you security. Here we're talking about cash equity, because when you go to the bank to refinance, right, they're going to come back and say, okay, you've got a building worth 12.762, right? And let's do the actual, let me show you the actual numbers. They're going to come and say, now your outstanding loan is 4.8 million. We like to say that you're still willing to refinance you at a loan to value of 80%. So what they would do then is they would come, can everyone see? So let's go here, and we would see the gearing would be 80%. So would you agree then it's 80% of the value, loan to value? That's what you would go to the bank and say, we want to reach this facility. We've got a building that's now worth 12 million. We want to get an 80% loan against that 12 million. Are we together? Okay? So what would that value be? It would be the 10.2. So your new loan, it's a new loan document. It's for 10.2 million. But the difference between this new loan and the existing, it's the 10.2 minus the 4.8. So that would be a refinance. You're not selling the building. You're not pledging collateral. Financing existing facility. And you'd be able to create value, cash equity of 5.4, which is invested in the new projects. Remembering as an SHI, you can't take that money out, go and buy Ferrari. That's not going to happen. So your point is right, that it's not like money that you can take out and go and spend, but you can restructure, employ your capital, so that as an SHI, now you can look at the next project and you've got equity to contribute. Exactly. But there's risk. So we can't, it's not a clear-cut assumption that you can just go and gear 80% over and over. More realistically, what's likely to happen is the bank would come and say, because this is a restructure, we're not going to give you 80%, we'll give you 60%. But it allows you to release equity. So the thinking is the same. You know, we don't want you to take too much risk. We're only going to gear you 60%, maybe 70%. That's how they would think about it. That's where the risk management comes in. Mike, Henry? Okay, so I'm going to move, after this point, I'm going to move on a little bit because I suppose we've introduced the concept and we can get into it over lunch if anyone wants to discuss.
Thanks, Khomozo. Our sinister are It's just that the pity, I don't think she was audible enough. But the point is, and maybe also to respond to the gentleman also earlier, inquiry about how it relates with SHRA or being an SHI and so forth. What is important of what I am noting, and which I hope others will also note it equally, is the fact that you are illustrating to us the building blocks or the enablers of creating that equity that is being a challenge. So what he's basically showing us are the principles. They may relate to a different type of category of property segments, but in essence, it's the same principle that applies. I love that inquiry that the gentleman from that same side made yesterday about holding an asset somewhere else, where the intent is to actually raise cap for a new opportunity against that asset.
Yeah.
So thanks very much. That's the point that I want to make. Thanks.
One last question over at the back.
Yes.
New entrant property players, developers to come in. You've just explained the model to actually get the upside. But maybe in tandem, we then look at how do you then buy the Ferrari in the long-term strategy. The property management, if you've got a strategic construction team that you play with, if you are in the innovative space, fintech, you know what I mean? It cannot be limited to just waiting it out for the equity play, because I don't think everybody's here for that. Everybody's here to make a play, and the challenge obviously is resources, where you actually come up with cool concepts in line with SHRA's modalities, if you like.
Yeah. Okay. I suppose that's not a question, it's just you're adding to the floor, that there's different ways to make what you called ancillary sources of income from owning the asset.
Okay, my question is, if you're gonna be accredited as an ODA, you are required to raise the 20% equity. My question is, does it matter how you raise that equity? Does SHRA go into depth in terms of your shareholder agreement and preferential shares and things like those components within your company, or they're just happy if you raise the 20%? My second question is, earlier on you spoke about the makeup of the housing and the commercial, but then you then said the 20% of the total cost of the project. So the commercial still makes part of the walls, but then that part SHRA doesn't consider when they do their financing. Then why does the 20% also include the total cost of the project? And why don't they subtract the commercial one, because it's not part of what they fund? Thank you.
Okay. So let's talk about the equity first. So the equity has to be a commit, if you're an ODA, it has to be 20% of the budget. So if the budget is 100 million, it has to be in equity or equity-like. So what does that mean? Either be that 20 million is the value of the land. So if the project is going to cost 100 million, but the land is worth 20, that is equity. Unencumbered value of the land. So i.e. there can't be a bond for 20 million against the land. But let's say there's a zero bond and the value of the land is 20 and you do a valuation, that is equity, no problem. Or can be 20 million cash in the bank, that's the easiest. Or it can be a shareholder loan. And that's to answer where you are coming from. What is a shareholder loan? Shareholder loan is, I'm doing this as an ODA. I invite you, sorry, the name gave? Tando. I invite Tando. Tando's got a rich uncle. and he says he's willing to invest 20 million in this project, but he's going to invest it as a shareholder loan. So as a loan into this business. In that scenario, the SHRA would want to see that shareholder loan agreement. They want to see that. Because remember we talked yesterday about what is the difference between equity and debt, fundamentally. The accountants would say equity is the residual claim on a business. So when a business let me just finish, business gets into trouble, who claims first? The creditors. So you've seen with the SAA story. Those guys stand in line first. They've got the priority claim. After that comes maybe the secondary holders are also debt holders. The last person to get paid is the shareholder, the equity. So, and the shareholders only get paid if there's what? Left over. There's nothing left over, shareholder must wait. Hopefully it doesn't go into business rescue, but yeah. So that's the principle, that shareholder loan needs to have that principle in it, that his payment, whatever his return that he wants on that loan, it needs to be a residual claim. What does that mean? He gets paid after we've paid all our operating income, after we've paid interest expense on the normal loans, after we've paid our taxes, then there's what's called distributable cash to shareholders. That's when he gets paid. So if at the end of the year there's no money to distribute, what happens? Doesn't get paid, Thando doesn't get paid, and whatever return he was charging rolls over to the next year, and so on. So in finance, we would call it a cumulative preference share. It has to behave like a cumulative pref. It accumulates every year. Yes, I can pay. When I've got money, I pay him, it reduces the size of the pref, and that's how it goes. If you do it like that, you must have a shareholder loan agreement, a pref share agreement, a MES loan agreement. The SHRA will want that to see that and look at that.
So, find this funny clauses that speaks about if the shareholder puts money into the company and there is no balance between the two, if let's say there's two shareholders, between the two shareholder loan account, then the one that has the highest contribution gets paid first. So will such clauses put you at a disadvantage when it comes to the funding from SHRA?
Well, those are clauses that talk about how you as a business operate. So the funding is capital, but it doesn't really dictate how you as shareholders structure your equity contributions. So it's not like it's going to put you at a disadvantage with the SHRA, but it depends which shareholder you are in that agreement. Obviously, if you're the one who's not putting in the capital, then yes, you're at a...
To that point, let's unpack it, because if I get an investor that says, I'm willing to give you money, but on basis of preferential shares, which is exactly what she's referring to, yes. And that is the only way I can secure funds to bring into the project. The SHRA now says, because I have to now, reveal to SHRA that this is the agreement between me and the investor, would that disadvantage, or would that be excluded? Because now with preferential shares, that investor needs to be paid before everything.
No, so maybe we're not unpacking what a preference share does. So we've got a company. He's investing in my company as a preference shareholder. That is a commitment. Just because I'm getting the grants from SHRA, remember the SHRA isn't funding me, it's not even funding Thando, it's funding the entity. So it's providing the capital to the entity. If for whatever reason me and Thando get into a dispute because I've breached my agreement with him, there must be an agreement that stipulates what happens in those scenarios. And the SHRA sees the entity. It doesn't see me, doesn't see Thando. It sees the entity and the commitments that the entity has made. So if that agreement, turns against you because you haven't fulfilled whatever their obligations, the funding is not the individual, it's the entity.
also coming in as a investor under an entity umbrella would also be, you know, the agreement that you have. So in essence, what I want to understand is that would that be an option, because that is what would be out there for me, and I would go into that agreement and come back to SHRA and say, this is the investment partner that I'm bringing. Even though the arrangement individually does not affect the entity that SHRA is funding, but at the end of the day, it does have an impact.
Yes, it's most certainly, because the worst case scenario is you are the ODA who's committed to social housing in the sector, and you get an investor who, for whatever reason, puts you in breach and takes over the entity, but they're not committed to social housing. So therefore, the SHRA would want to make sure that they've done their diligence on that shareholder or preference share agreement that you're entering into. So you can't do it without submitting it to the SHRA. Let's go back to you.
So I'm hoping that you will explain it so that we all understand when we live here. Because after we live here, the goal is going to be, if I register as an ODA, how do I raise that 20% if I don't have that 20%? Yes. So the mistake we don't want to make is to get into agreements with shareholders that are going to hinder the process of applying to SHRA. So the clauses that I'm talking about, they are usually in shareholder agreements, meaning that they affect the actual entity itself and how it dispenses its money. And you do find in some shareholder agreements whereby the shareholder gets paid first, even above some of the creditors. So that's where I'm saying, when SHRA does their due diligence, does that matter or does it not matter? Because when we live here and I go and look for that 20% and I sign shareholder agreements with whoever is going to be bringing that 20%, I need to be sure that it won't hamper. This is the second phase. It won't hamper this process. Yes. Thank you.
When you are looking for a shareholder, your first point of call, try to go and get an institution rather than an individual, where you can go and borrow that money, either as mezzanine financing, you know, with the likes of the NEF, the DBSA. Try to go to institutions. As individuals, there's always, you know, different strategies. You go to an individual as a last resort. But your first point of call is try to go and look for almost what is called a like-minded partner. This is a marriage that you are going to be going into. So you want to make sure that you are all at Eden, you all understand each other, so that you don't end up having this conflict. So your first point of call is for you to go to the likes of the NEF to see if they cannot finance you that 20%, which will be slightly, you know, at a mezzanine rate. If that fails, then you go and look for a like-minded partner. But whatever agreement is between you and your like-minded partner, the SHRA will look at that agreement, what it entails. What are the clauses of that agreement, so that it doesn't prejudice the SHI or the ODA.
Yeah. And maybe to close that one, you wouldn't be able to, well, I don't think the SHRA would accept that you enter into any shareholders or loan agreements without submitting it to them for review. So all of those conditions will be reviewed by the SHRA, and then they'll give you feedback on whether it's going to be accepted or not.
Sorry, I was saying, if you put collateral down, what kind of effect does it have? Does it decrease your interest repayment and increase your principal debt from the banks?
Okay, so let's unpack what collateral is. If you're saying, I want to borrow 10 million, but I've got 2 million rand as collateral, in the sense that you want to put an asset that's worth 2 million as collateral. You're not going to refinance and generate 2 million as cash to put into the facility. That would affect the risk grading of the facility. So the bank would say, well, you know, we're borrowing to this entity 10 million, but they've got security of 2 million rand. So how much risk are we taking? If anything goes wrong and we had to go and auction this property, if we got 5 million, we could always go and take 2 million, which was placed as collateral. That would affect the term of the loan and the interest rate on the loan. It wouldn't really affect the amount of the facility that they would borrow you, because the facility must be able to be supported by what? Operating income, service cover ratio. So it would affect the risk grading on the facility, which affects the term and the interest rates. So are you going to get prime plus 1, prime minus a minus 2, or minus 3? Okay, so I'm going to move on a little bit there, unless anyone feels that there's anything that we need to unpack a little bit more. Okay. Assets. We're still on the balance sheet. So we said balance sheet is O equals A minus L. Typically, your assets will be fixed assets and current assets. I'm going to keep it very simple. Fixed assets are the building, if you're in construction, your yellow metal, your tipper trucks. So anything that you can't convert into cash quickly, i.e. within 12 months, we categorize it as fixed assets. Current assets, anything that you can convert into cash within 12 months. Cash in the bank, stocks that you've invested in, and I guess, which one's the big one that I'm not talking about? Debtors, trading stock, inventory. Okay, so those will be current assets. Current liabilities, the same. Anything that you have to repay within 12 months, and then long-term liabilities, anything that you only have to repay after 12 months. So typically the loans that you would use to finance these properties would be long-term liabilities. What's something that I only learned after being in property for a while that is a big problem in property businesses? I'll link it to the municipality. Trade payables. Who's coming? The property manager in the building. Trade payables. So, you know those invoices you get from City of Joburg, where 1 month your electricity bill is 200,000, then it shoots to 4 million. And you're like, but guys, what's going on here? What are those invoices doing? It's short-term liabilities, so it affects what? Your trade payables. So no one's come across that problem? You have? So short-term liabilities can also be your trade payables, which includes your municipal accounts. Shareholder interests, share capital, that is really equity. We've discussed this at length. Now we're moving into the QS side of the process. Who are the QSs in the room? Okay, they're hiding from us too. QS? Development costs. So the development costs. So remember now we were talking about the income statement and the balance sheet. A lot of what we've been talking about is when we are running the building. Now we're moving into when we are building the building, before it's operating. So development costs would be everything, includes everything from the land, the construction, those contingencies, all the stuff that Henry talked about yesterday, or we call it under the development costs. And under that, you can see is the land. I'm not going to go into geotechs. Henry gave ample discussion on why geotech is so important. But under the building costs, there's also professional fees. What are the professional fees? Architects, engineers. Agreed. We're not going to get into a debate on what the professional fee percentage should be, because it's always different. You know, everybody feels very strongly about it. But in the sector, it's anywhere between 8.5 to 12.5%. I know that the professional bodies are much higher, but the sector is somewhere there. And it depends on the negotiation between you as a developer and the professional team. So now we talked about funding. So now we're getting into the nitty-gritty of funding. So we've talked a lot about the equity, how you raise the equity. It's a problem for ODAs. Let's just talk about the debt for now. Where would you get the debt? What you call the senior loan. Why would they call it senior loan? Senior loan, junior loan. It's about the claim, where you stand in the claim. When the business is in trouble, senior loan, they get to claim first. Junior loan, second. Who's lost? Equity, shareholders. So in the market now, there's obviously NHFC has been the primary funder to the sector, but there's new players now. National Empowerment Fund, like Henry said to the lady, preference share funding, MES funding, these guys are doing it. IHS, they're doing the prefs, NEFs, they're doing the mezzanine, and TUF is more doing the senior debt funding. But we've also seen the banks coming into the sector now. Nedbank is active, ABSA is definitely active, and FNB slowly but surely is coming into the market. So, in the capital structure, where we get the money to build the development, we said if you're an ODA, you have to have equity. How much? 20%. Land can be equity if it's unencumbered. So you can't have a bond against the land. Okay? Then the debt funding, we've talked about that. What do you need to have when you to SHRA? For both, you need to have, when you first submit, you need to have a letter of interest from the bank, which notes the project location, your entity, and also the amount that you want. You don't need to have a full term sheet. But then to move from the process to get into what they call project accreditation, technical evaluation, so those are the detailed SHRA processes. At that stage, you must have a term sheet. Because what does a term sheet gives you? It gives you the pricing. And by the time that the bank gives you a term sheet, they've kind of done a basic due diligence. So it's not the case that in your first submission, when you are saying, SHRA, we've got this project, we want to be on your pipeline. Then you just have to have a letter outlining the expression of interest for both the debt, but you must also have a letter outlining how you're going to structure your equity if you're an ODA. Then there's the grant. Henry mentioned yesterday that now it's a consolidated capital grant, which was, the restructuring capital grant and the provincial subsidy together makes the CCG, consolidated capital grant. And then for SHIs, typically there's also donations, which would effectively contribute as equity. Won't go through that, we've discussed that. Share capital applies to ODAs, mostly that they need the 20% and the long-term debt. I think we can break for tea. Can we keep it to 15 minutes? So it's 11 now, can we be back at 11:15? Is it good? Okay. So we're through the most boring part of the morning. How are we feeling? As in the most difficult part, like it's the basics. It's slow. Normally people they get a bit, like, come on, let's get to the juicy stuff. Are we still together? All right. So now we move to the key performance indicators. These are the most important 5 items, because when you submit your QuickScan C to the SHRA, what happens is it gets assessed by the projects and development and funding team. Then they send it to an external assessor. The external assessor is looking to make sure you've met these key performance indicators. So, debt service cover ratio. We've spent a lot of time on this. I'm not going to talk to what it is. I'm going to ask for help. Can someone help me with with the formula for debt service cover ratio? How do we calculate it? Tando, can you help me? It's on the screen. Yeah. Okay. Okay. So he said it's gross income less operating costs divided by total debt service costs. We've glossed over this a little bit today as to say, what do we mean when we say total debt service costs? What goes into it? It's there, it's the interest plus the capital repayment. Who's ever seen that when you have a car loan, your loan on your car, the principal, the bond payment, the payment stays the same, except it changes when interest rates move up and down. But it stays the same, whether you've been paying it for 2 years or 3 years. Am I right? But when you get your statement, what starts happening to the balance outstanding? What does the balance outstanding look like at year 2? And if it's a 6-year loan, what does it look like at year 4.5? Who's noticed something funny happens? So if you look at your statement in the first 2 years, you're paying and paying, but nothing's happening to the balance. It stays the same. It looks like you're not making a dent. But once you're from year 4 onwards, every month it starts dropping quite fast. So that's that whole thing of, on your installment, it's made up of interest and principal. And it's just that I don't have a curve a board to draw on, but it typically looks something quite like that. That the principal is it drops off a lot towards the end of the facility, because now you are paying off more and more. That installment that you're paying is almost 80% principal, 20% interest, but in the beginning it's 80% interest, 20% principal.
And this is why you find, if you have got a housing bond, and you are paying every month, after 5 years, you get a statement, and you see, you still haven't done anything to the capital. And then you start asking, but, I've been paying my bond every month. Because those early years, all what you are doing is you are servicing interest. It's just to put it into the loan.
Okay. So we're comfortable with debt service cover ratio. It must be at least 1.3. Like Henry mentioned, it's a measure of how much headroom you have before you start sinking. So obviously if your debt service cover ratio is 1, it means that your income divided by what you have to pay, your installment, is the same. So if interest rates increase, vacancy increases, COVID happens, Afrikaans sê jy verdwyn. No. Tax. No. Tax is always below the line. Doesn't affect the debt service cover ratio. Hence why all the tax considerations when you're doing your returns don't really affect the debt service cover ratio. Because it's operating income, which is revenue minus expenses, divided by the installment, interest payment plus principal repayment.
And that also applies to your valuation.
Yes. So in property, for the most part, tax really comes late. You'll very rarely hear property people talking about tax. And the main reason for that is every company is different. Every company is structured differently. Like, for example, you know that with a REIT, if you own a REIT, a listed company, when they pay you those, it's not distributions, it's not dividends, it's distributions. Because when you get them, the tax hasn't been paid. You must pay the tax. So you can't assume that you're getting after-tax money. It's pre-tax money. Because REITs don't pay the tax. They distribute all the operating income. Okay. Now, IRR. And I'm going to put a disclaimer. I know that this is going to be another one where we're going to get stuck. We're going to get stuck, disclaimer, but let's unpack it. What is an IRR? Why did I spend so much time going through cap rates and initial yields? So can we recap? What was the initial yield? The return on a specific building. We calculated as 1 year's operating income divided by the cost to either build the building or to buy the building. So that's initial yield. The cap rate is the same formula, but it's driven by the market. It's not specific to one building. So if I'm thinking about high density residential in a CBD, there will be a cap rate for that. If I'm thinking about urban, suburban, low density, there will be a cap rate for that. IRR. But now, actually, maybe let's take it like this. Now, we had those two buildings. We had your initial yield was 10, mine was 15, the market cap rate was 12%. Now I'm deciding I need money. So I need to raise some capital. And I want to sell my building to Umdu. Sorry to put you under pressure, Umdu. And I come to you and I say, Umdu, I want to sell you this building. The cap rate for this kind of building is 12%. Do you want to buy it? What's the calculation Mdu must go and do? Let's say Mdu has 10 million rand in the bank. Firstly, that money is sitting in the bank. We said it's not under his mattress, so it's earning interest. What kind of interest can it earn? Who's heard of money market? Money market deposit accounts, fixed deposit. Right now, I guess, if prime is at 10.75, money market should be what, 7.5? Yeah, 7.4. So your money is earning 7.4. Would we agree that from Mdu to even talk to me, I must give him 7.4 and plus? Because he's already getting 7.4. Okay? Mdu's a bit more aggressive. He hasn't put it in the money market, he's put it in the stock market. I know the stock market recently has been a bad place to be because things have not been good. Historically, the JSE, before 2013, used to give an annual return of 13%. So it doesn't mean that every year you're going to get 13%, but if you average it over 5 years, you were getting 13%. 2013 to 2019 was very bad. I won't say why, but the JSE's average was about 4 to 5%. So you underperformed cash if you were in the JSE over that period. I'm sure all of you can interpret what happened in the country during that period. So now, it's even, actually, after COVID, it bounced back. It shot up to about 14%, but that's because we were recovering from the pandemic. So let's just assume that we're still in the good times and you could get 13% in the JSE. So he's got all his money. In fact, he's got all his money in MTN. Actually, no, MTN's not a good one right now. What's it? In the pharma, yeah, vaccine industry. You're getting 15%. Yeah, so that all depends what's happening with oil. So let's just say he's getting 15%. What do I have to do to entice him to buy my building? Actually, that's an example. He's getting 15% in the JSE. The cap rate is 12%, which is like, what is a cap rate? It's a return on capital that you value. Is he going to invest? Why? Okay. Now let's say the JSE moves from 15 to 12. So I'm offering him the same. Should he invest? What is the difference between the JSE and property? Yeah. Would you agree that if I want to invest in MTN, because it's listed, the information you have and I have is the same? When you get the information is the same. When directors are doing bad things, you know, I will know. When they've got deals in the pipeline, you know, I will know. The only way you would know something that I don't know is if you've got insider trading, which is illegal. So it's got what? Transparency. Whereas property is very intransparent. Who made the point yesterday that it's like some people know things more than others? That's a character of property, lack of transparency. It's just the way the industry works. That's why these guys with Bitcoin are trying to do all these things to address some of these issues. What's another characteristics of the stock market? Governance. There's set governance. When you invest in the stock market or you read a shareholder's report, you're getting some sort of idea of how these people run this business. Whereas in property, I don't know how you run your business. I don't know how you run your business. You don't have to tell me anything. What's the big one? Liquidity. If we own Sasol and we hear that for some reason in Saudi Arabia they're going to flood their market with oil, what are we going to do? We're going to sell because the oil price goes down, Sasol share price will get impacted. And you can sell like that. Within 24 hours you'll be out. You'll probably take a loss, but can you do that with property? It'll take you about a month and a half to get out if you're lucky. So liquidity and transparency are a problem. So therefore, yeah, exactly. Very good point. Very good point. But then, actually, let's take it a bit further. If Steinhoff was unlisted, because remember, the PIC and all these funds do invest in unlisted equities. If it was unlisted, do you think the problem would be worse or better? 10 times worse because no one would have found out. It would still be trading today. They'd be doing all the stuff they're doing, no one would know. Okay. You know what? That's a fair point. That's a debatable point. That's a fair point. So transparency and liquidity. So now going back to this example, he's getting 12% in the stock market. I'm offering him 12%. Should he invest? No, because he can get 12% where no matter what happens, he can sell, get out within 24 hours. He can get 12% where he knows how we run our business. He's got financial statements, and he's getting information that is transparent. So then there's what we call a risk and liquidity premium for property, which is, based on above a benchmark. You must have some sort of you must compensate me for the fact that I can't sell quickly. You must compensate me for the fact that it's illiquid and it's intransparent. So there's that premium that you have to offer. I would have to offer him maybe 15%. I would have to offer him maybe 18%. How do you do that calculation? That's what the IRR is. Remember we said the initial yield is building specific. The cap rate is market, but for a specific type of property in a specific industry. An IRR, all an IRR is, it says, I've got an investment. How much am I going to pay in today? What are the cash flows that I'm going to get over a specific period of time, whether it's 2 years, whether it's 5 years. It's not industry specific, it's not sector specific, it's cash flow specific. So what does it allow me to do? It allows me to compare apples with apples. So essentially with the IRR, I would say if I'm investing in this project and it's giving me 12.5%, I can compare that directly to a return, an IRR in equities, obviously adjusting for the risk, that risk premium that we have to adjust for, but they're comparable because it's numbers to numbers. It's not that industry to that industry, that property to that property. It's about cash flows going in and cash flows going out. I invest 10 million today, I earn 1 million a year for the next 5 years. What is the average return on that? Are we?
Given the opportunity that your company reaches a point of 50 million rands turnover, which qualifies you to now take an option of investing in the JSE. So what would be the advice based on the performance of the company at that point? Would it be advisable to go to the stock exchange or still look for unlisted companies?
Are you talking about if you're a developer or if you're an investor?
If you are a developer.
I'm not quite sure I'm following that question, Henry. Can you?
Look, if you're a developer, the 50 million threshold that you're talking about, you can invest any amount of shares on the JSE. Remember the example that I gave you yesterday of that student who was buying one share in high prop and all that. So the amount is not necessarily a determining factor. Yes, if you have got more, you can invest in the JSE. But what you have is you have got a number of asset classes that you can invest in. One is cash, where you can put money in your Standard Bank, in Capitec and that, and you get a return of 8%. You can invest in the JSE, where you get about 13%. You can also buy a government bond, a 10-year government bond, where you get an interest. I think 10-year government bond is at about 11.25. And you can invest in real estate, whether it's a REITs or in an unlisted fund as a developer. But remember, you then need to look at your risk profile. Which of these investment classes suits my investment strategy? You might decide to go, even when you go into property investment, there is industrial, there is retail, and there's offices, and we have seen what has happened with the office market now. You know, everybody's running away from office, or they are converting the offices into residential. So you need to be able to look at all that and make a decision to say, where should I be putting my money? Where do I think I'm going to get a better return? And remember with the property, that's why we're talking about gearing. You know, your level of gearing, that gearing enhances your returns. So if you were going to go into the JSE, most likely you are not going to be able to gear unless you are a big corporate. Whereas with your real estate, because you are going to develop, let's say, Melrose Arch, you know, you have got all these bankers wanting to fund that development, and you can use the power of gearing to actually leverage your return. So it depends with your investment strategy.
Yeah.
Yeah.
Actually, as I'm thinking about your question, it actually all boils down to also what your required return is. So you need to make sure that if your required return when you're doing your assessment is 15%, but the market can only give, the stock market is giving 12, and your projects can give you 15%, it makes more sense to do your projects. But if you can't generate a return that beats the market, you should be investing in the market, because you know you'd be better employing your capital in that in that space. So now I want to answer a question that we were talking about earlier where they were saying, should I be using my equity, shouldn't I be using my equity? So can we first agree that an IRR is about cash flows? Doesn't have to be asset specific, but obviously the return you're getting from that asset is what creates that IRR, right? Who's heard of levered IRR, unlevered IRR? So if your cash flows, when you're looking at those cash flows, if you're looking at cash flows before you've adjusted for leverage or cash flows after you've adjusted for leverage, would you agree then that it takes into account what you were talking about as to, if I want to understand what the return on my 2 million is, I need to look at, I'm investing 2 million rand today, what am I going to get as cash flows, as dividends, cash flows to me as a shareholder? In finance, we call it free cash flow to equity. I don't know if you want to help me there. Is that correct? Do you understand that if you wanted to understand whether you should use 2 million versus you should use 3 million, you would do an IRR calculation, but on the equity investment, not necessarily on the project. Because what we would be looking at here would be on the project. So you buy the project for 10 million, you earn operating income of 1 million over a specific number of years. The other way to do it, when you want to understand on how much equity should I be using, that's the required return on equity. Then you're looking at, should I be investing 3 million? And if I invest 3 million, how much are my dividends going to be? Versus if I'm investing 2 million, how much are my dividends going to be? So it's a different type of calculation. But that's how you would decide whether this project is giving me enough return on my equity. Okay. So I'm going to move on there. Is everyone happy that we move on from that? Okay. So those are the first two key performance indicators, debt service cover ratios and IRR. Then we come here to operating costs per unit per month. Now, before we go there, I'm going to switch to PDF now. Who remembers this table that Henry showed us yesterday, which is the income bands? We all remember that one? So that shows the rentals per income band 1, 2, 3, 4, and 5. So it's split up by household income, and then over here it shows the maximum rental and the average rental that you can rent a building for. That you can rent a unit for. And Henry mentioned yesterday that the average rental is 3,377. When we were talking about vacancy earlier, if you've got a social housing building, where do you think the vacancy will be? Here. So if you're calculating your vacancy, just always make sure that when you're doing your model, if you have a vacancy of 10%, it's likely that whole vacancy is going to be at the units that are renting at 6,400. So if you've got 100 units, 10 units, that's the vacancy, times 6,400. That number is going to look very different as if you in your model say, my vacancy is 10% of average rent, which would be 10 units times 3,300. That's 33,000. But actually, it's going to be about 64,000. It's also about how you calculate this. If your weighted average is correct, it should be fairly close. But if you just take an average rental and you said 3,000, what your cash flow lost on vacancy is versus what it actually ends up as is going to be very different. But now, if our weighted average rental is 3,300 per unit, that's the weighted average. But one of our key performance indicators, I'm going back to the presentation. But one of our key performance indicators is that your operating cost per unit per month must be 1,350. And then Henry mentioned yesterday for SHRs it's 1,600. What's 1,600 divided by 3.3? It's more than 50%. That's something that's very important to think about, that this operating cost per unit per month is actually more than 50% of your total revenue on your building. But why do they do that? So that 1.3 is made up of the direct operating costs and the overheads. But in that number is also the maintenance reserve, which is the next KPI, maintenance as a percentage of development cost. So you are required every year to reserve in an interest earning account that you can't spend, obviously, unless it's for maintenance, 1.02% of the project budget. So if your project was 100 million, what would you have to put aside? 1 million every year. The next year must be 1 million. Next year must be 1 million. What is that for? It's for the planned maintenance. So roof repairs, painting the external facade. Is it for things like changing broken tiles? No. We call that ad hoc maintenance or reactive maintenance. It's for the big things. You have to keep it in an interest-bearing account and you have to put it aside. But that 1 million is part of your maintenance reserve budget, which affects that 1,350. So we've covered 4 KPIs now. The debt service cover ratio, 1.3. The IRR, and the IRR that the SHRA has set is that it must be prime plus 4.5. So if prime is 10.75, it would be 15.25. But is that enough? Because what do we say IRR is? It's the return on the investment. So what would you have to do? You'd have to go and look at what else, what could I get somewhere else? Is there another project that could give me 15.25? If there is, you should probably go and do that project, if you have the equity, obviously. So are we seeing what the IRR is? It's a way to compare cash flows with cash flows, apples with apples, even though the investments might not be exactly the same. But because IRR focuses on cash flows, you can compare one investment with another investment. Then we talked about operating costs per unit per month, must be 1,350, but you'll see that the big driver of that number is the maintenance reserve. Then the maintenance reserve, and then the development cost. So pre-COVID, that number was still around 400,000, but everything's moved now to around 480,000. Who's recently submitted a project? Where are the projects coming out at a cost per unit? Anyone?
Okay. What was your...
Do you want the real answer or the fake answer?
The real answer.
The real answer, they're coming up to like 530, so 530, so it's more than that 480.
Okay.
Realistically, if you are putting the minimum finishes in the project. So if you want to remove, let's say, the plaster on the walls and you have different, you're going cheap on most of the products, then you'll get to a 480.
Yeah.
But realistically, for a nice, basic, comfortable unit, it's about 530, realistically.
530. And why do we keep harping on about that? And I don't want to create an argument, but often what happens is there's a lot of us who are in industry who, some of us are owner developers. So we're the developer plus we are the contractor. Owner developers will always tell you they can beat that number. They'll tell you they can do it for 380 or 370. But the problem with that is, if I'm an owner developer and the SHRA gives me that grant and I start building, but now often we know with construction that your capital is split between different projects. If on project A for some reason something goes wrong and I don't get paid, now all of a sudden everything else gets into trouble. But now the SHRA has funded this project, assuming you can build it for 380. All of a sudden, I can't build it myself, I must go to market. I must go to TriStar, I must go to TrendCon. They're gonna come back and say, this is the market. All of a sudden, that project moves from 380 to 530. The project is stuck. Sorry? 460 on 1,000 units. Okay. Okay. It's about the scale. Okay. But I can promise you that this is it's a never-ending discussion, because I think where she's coming from, that 530 is for over 1,000 units, no? 1,600. So it's an ongoing discussion, but it's somewhere around 480 to 500. So it's shifted.
It's not a 4-story walk-up. It's more than the 4 stories. It was 10. Some of the buildings, so it's like 4 blocks of buildings, and some of it was 10 stories and 8 stories. So I think we mentioned yesterday, Henry mentioned yesterday, that once you start going more than 5 stories, then your costs just shoot up incredibly for the lifts and the core maintenance. There's just a lot of things to maintain. But if you keep it at a lower density, then you can achieve those numbers. So if you just have a few blocks with 4 stories or 3 stories, you don't have any lifts, no really big service things, then you can get to those numbers. But once you start going multi-story, it is the development, both. It's the development and the maintenance.
On your density, so the cost of your land is way cheaper, and most likely even the cost of your of other things, you know, running. So it's operating costs.
If I could add to that, it's actually, what's the rule? Kevin, can you help me? The rule of thumb is you want to keep your building under, is it 25 or 26 meters? Because anything above that is a 30, where you need pressurized staircases, and that's a fortune. So the high rises, that's where it becomes very expensive, because some of the fire requirements, the foundations, the types of slabs that you have to do, the loadings. So,
no, this is just for humor only. We need it. It depends as to who you ask. And in this instance, you ask the architect, with all due respect. And in this instance, here's the beauty. He just disclosed earlier, he's an engineer. Okay. So he may be conservative, typically gray, and we over-design in terms of the structures. And then in that instance, the developer's point of view, he's just proving to you that, listen, I can go for it.
Yeah.
So it depends as to who you ask.
Yeah. Okay, so we know that the development cost is a big
Sorry,
bench-
Khomotso.
Oh,
Can
sorry.
you elaborate more for us on the walk-ups? Because we just have a small information about the specification. Why is the walk-ups more expensive than the normal? Can you just elaborate on that?
So no, so they were saying that the high-rise buildings are more expensive than the walk-ups. Obviously, the walk-ups is a fairly straightforward structural design. You know, if you've got very good land, you're going to do normal foundations. Hopefully it's not a raft, it's strip footings. And then, you know, you can even do, instead of load-bearing columns, you can do load-bearing brickwork. Makes it very, very cost-effective. To design a 3-story walk-up, there's no lifts. The fire requirements are often much more straightforward on a 3-story walk-up. Oh, sorry, so the 30, is it 30 meters or 26? 30 meters. Any building over 30 meters, the staircases and the lift shafts must be pressurized, which, for fire, which is very expensive. Yeah.
Perhaps in your 50th or 60th, those properties more long-term.
Yeah.
So once you've turned the corner, then your return on that property becomes really high. But your initial costs are high, so it depends on your capacity to wait it out as a developer.
Right.
But the long term, you definitely benefit if you go with the lifts and higher buildings.
Okay. So, can I just make one last point? The reason why we need to keep this in mind, for the quick scan C, there's two things that drive this thing. Your debt service cover ratio and the cost. If the costs are out, the quick scan C won't work. If the costs are out, you're going to be borrowing more than you need to, so your debt service cover ratio won't work. So this is a very important number, the total development cost.
Yeah, Khumotso, I just wanted to add, I think to the optimal building area would be your 4-story walk-up in terms of cost and savings in that.
Yeah.
Bearing brickwork, no lifts.
Yeah. Can I throw something out there? Maybe the engineers can help us. So I 100% agree with you, but what happens when you've got a site that is zoned for 4-story walk-ups, but it's a big stand, and now your blocks are far away from each other? Is that still true? I'll throw it out to the engineers. That the 4-story walk-up is still cheaper. And what I'm saying is, if you've got a big stand and the blocks are spread apart, what's wrong with that? What problem does that create?
I mean, Henry also mentioned yesterday to say we must take note of the costs that comes with the maintenance of that lift, the load shedding that is at the current moment, obviously having to think of those to say, okay, let me go solar. That's another cost. So yeah, I think 4 stories.
Without necessarily directly responding to your question, because as you said, to the engineers. So in this industry, from a developer's point of view or project manager's point of view, we sort of have devised or developed a different type of language or literature in order to get away with some of these things, just so that you're aware.
Yeah.
For instance, in the case of, say, a restriction of 4 floors, probably the architect would know this. We'll probably say to the architect, listen, just do it 4 floors, give us your area schedule, but in our motivation, we'll say it's ground plus 3, with a view of trying to actually veer off from that. And then you use a specific or threshold of, say, 30 meters, okay, above ground. So it depends as to how you motivate it in the document. For example, that's how we got away with it with the corridors of freedom, where we justify and say, listen, from where we are humoring the actual original contours that are there, with a view of providing that bit. You're laughing, so you understand what I mean. So that then we get away in providing parking, for instance, in other aspects. So I'm just throwing it out there that that's another thing that those could be what could minimize the risk or the cost. Last one, in a case of a large spatial, for instance, and you decide to spread it, I'm just cautioning you, then you are triggering the issue pertaining to attenuation.
Okay. So I'm going to move on, but to just throw it out there, okay?
Answer for you, though. Just marrying what she said and what the lady in the corner spoke about, that if you're going to go high rise, your returns over time are higher. What is higher is the development cost, the initial outlay. But as you go on in your project life cycle, you start realizing that you're getting more returns than the guy that went low development cost. So shouldn't then SHRA be focusing mostly on the IRR? I bring a project, development cost per unit is more than 480, maybe it's sitting at 600, but over 10 years, my IRR is going maybe to 25%. So won't they try to see that there's a balance between that? If I come with a higher per unit development cost, shouldn't I be able to motivate to say, yes, my initial development cost is higher, but check my IRR after 20 years or after 10 years?
And you've jumped forward to the end of the session. So, and that's the answer is, why is it that her company is still getting these projects approved at 530? Because of the IRR. So the IRR is a big, big driver. But then it gets a bit more complicated because, yes, that's true. If you're an ODA, able to raise that debt or equity type. What happens if you're an SHI? Then you're stuck, because the higher the cost, the more debt you have to borrow, which affects debt service cover ratio. So it's a bit circular, and you have to find a balance. So just on that last one, what I was alluding to is, if you think about all these designs in Midrand, why is it that even if the stand is big, the blocks are close together? But we can take that one later. Okay, so operating indicators, vacancies, we've discussed that at quite in depth. Historically, most SHIs were between 5 to 10%. We've talked about the fact that in COVID it shot up to 16. Historically, in the market, it's 9%, but the quick scan C now starts at 7%. Bad debts provision, we haven't talked about this at all. What is it? So if I've got tenants, they're paying me my rent, then someone comes and says, you know, this month I can't pay, and we say it's fine, they've got arrears. Happens for 90 days, happens for 80 days. After 180 days, what do you typically do? You write it off. It becomes a bad debt. So that's the bad debts provision. So the bad debt provision is not arrears. It's the written off. And we provide that in any of these rental type of businesses, some of that rental we are going to have to write off. And the assumption in the quick can see is 3.5. The industry is sitting at, is it 6%, Henry? Around 6%. And, you know, there are SHRs and ODAs who do this much less. There are SHRs and ODAs, I think JHC, Karabali, you can help me, their numbers are sub 1%, aren't they? Well, before COVID. Before COVID. Yeah, after COVID, it's a different story. They are what we call good jockeys. They're very good at running social housing, but it's also the property management and tenant management. Operating indicators, I just want to come back to this because it's very important to understand that with social housing, your costs are 50% of your income. So how you manage your costs is everything. Because it's not like you can just wake up and decide, you know what, we're having a cost squeeze, let's increase our rents by 10%. You can't do that. So we have to manage our costs quite carefully. Okay, so now we're moving into feasibility costing basics. QSs, please put up your hands. I know you guys are here. You guys and ladies are here. Where are you? Okay. So what is a feasibility estimate? So there's a lot of, we use a lot of words quite loosely in the industry. So I can say I'm doing a feasibility study, but some people confuse that with a market study. So a market study is an assessment of the demographics and the potential market capture of a proposed project. It's about understanding who your end clients will be and how much demand they have for that offering, that product. A feasibility costing is a cost estimate to develop the project budget, taking everything into account, the land, the legal fees, the construction, the building cost, escalations, cost of services, earthworks, everything to develop and it gives you a development budget. In that also is an assessment of the potential return on the project. I've spent a lot of time on initial yields, cap rates, IRRs. Those are the returns on the project. So the feasibility estimate is used to basically develop an estimated project budget. But we talked about earlier about in construction what escalation is. Would we agree that if I start a budget today I've probably got 6 to 8 months before I turn soil, before I start building. But what's happening? Costs are moving in the time. So that's that pre-tender escalation. While I'm building, inflation's still happening, so that's post-tender. So let's not confuse the fact that even though for the most part, you're going to be required to sign a fixed price contract with your contractor. So i.e. when you sign, that price is fixed. But the contractor's price is already adjusted for the escalation. Hence why it's always important, I'll just finish this point, they always say, don't go to tender in October, November, because the contractors don't know what's going to happen with steel, so they're going to overprice. It's better, if you already hit November, just wait. Go to tender in February. You'll get a better price.
Okay, thank you. I just wanted to find out, what is the accuracy percentage for feasibility? A reasonable accuracy percentage?
I wish the QSs would be here, because it should be very close to 100. I mean, obviously, it's never, but it should be very, very close. And obviously QSs, because they know that, you can never know the future, or you never know what's going to happen, they often build themselves a bit of buffer, a little bit, outside of the contingency. They often, but as a developer, if I'm working with my QS, I'm expecting that the budget they give me is fairly close to what we will get when we go on tender. Obviously, often what happens is you get a budget, and then you go on tender, and all the contractors are 5% above your budget. Then you need to go back and do what they call value engineering, unless you can get more money. If there's no more money, you must go and adjust your budget back, your design back to fit in with your budget. But the numbers the QSs give you, you're supposed to be able to rely on them. Hence why they build in a buffer, so that they can rather surprise you with a saving versus cost overrun. Okay, so maybe just so that, obviously I don't know if everyone in the room has ever seen what a feasibility estimate looks like, but maybe before I go there, what are the 3 types of feasibility estimates we can get? Order of magnitude, elemental, and bill of quantities. So order of magnitude is very rough. It would say, okay, residential construction costs are 7,500 per square meter. This is a high-rise building, so it should be around 12,000 a square meter. We're building 10,000 square meters, 12 times 10,000. Then adjusting for some of the technical stuff. It's very rough. Elemental cost estimate breaks it down further into elements. It would say, in a construction, what are civil work? Well, what are maybe earthworks? What is civils, i.e. everything around the building? Then what is the actual structure, the building structure or structural elements? And then also maybe like specialized installations like your electrical, your plumbing, etc. I'm going to give you an example of that. The most detailed one is a bill of quantities, where it takes all those elements and it breaks it down into specific trade, brickwork over a specific amount of area. What is the price for brickwork? What is the price for labor? And it breaks it down. So the bill of quantities is the last step. Previously, when you applied to SHRA, you only had to give an elemental estimate. Now the rules have changed. When you apply, you need to give an elemental estimate, but to get past TEC, so i.e. to get to the approval stage, you have to have a bill of quantities, which is difficult because for a quantity surveyor, 40 to 60% of their work is done, especially if they're not a principal agent when they give you that BOQ. So often the QSs will push back to say, we're still on risk, but you want us to do 60% of our work on risk. So I don't have a good solution or an answer for that. It's just, unfortunately, where the SHRA's processes have moved to. But at least, when you are first applying, it's just an elemental estimate. Let me give you an example of an elemental estimate, and if there are questions, we can take them. I'm just going to move to a PDF. So here we can see a very, very basic elemental. I mean, I think actually there's an elemental estimate, and then there's what they would call a cost estimate, which is slightly more detailed than this. But typically what you're going to get is you're going to get the cost of the land, any project fees, so i.e. attorney's fees, transfer duties if applicable, and then under construction you'll have alterations. So alterations would be if it's an existing buildings and you must go and knock things down and change things. Concrete formwork, reinforcement, masonry, that's your brickwork, waterproofing, roof coverings, carpentry, those are your BICs, ceilings, ironmongery, those are your door handles, metalwork, that'll be everything from if you've got balustrading and even more stuff. I'm not going to go through all of these. Then I talked about specialist installations, the electrical installation, things like CCTV, fire protection, the lift, and then the external works and P's and G's. We haven't talked about P's and G's. Anyone can help us on P's and G's? Contractors' overheads. So it's the cost for the contractor to be on site. Why is that so important in social housing? And I'll give you a clue. Why is it important on a smaller project versus bigger projects? So what you find is, firstly, the SHRA needs your contractors to have CIDB, right? There's CIDB 7, which is, I think, they can do contracts up to 40, 45 million, I might be off. There's CIDB 8, and then CIDB, right? Now, a lot of the times, contractors with CIDB 9 can do projects over 100 million. I might be wrong. But now, their overheads to get on site are a lot higher than someone who's got CIDB 7. Their construction managers, maybe they might have more, maybe they might earn more, but generally, just to come on sites, the cost to bring WBHO onto your site is a lot more than to bring someone who's got a CIDB 7. So what happens when you've got a project that is 200 units? Can you do 200 units with CIDB? You can do it with CIDB 8, right? Yeah. So if it's about 80 million, you can do it with CIDB 8. So then what happens? Where you go out on tender, and you might find that the contractors who are only at CIDB 7, they can come in at P's and G's of 9, 10%. The guys at CIDB 8 and above are going to come in at around 12, 13. What do? I'm just throwing it out there, so it's stuff to think about, that P's and G's on smaller projects become a challenge. Who asked the question yesterday about the minimum size of projects? So you're seeing how some of these things come into it, that once you're above 200 projects, 200 units, it's a lot easier to make these things work. Smaller projects becomes a lot more difficult. Yes. Yes.
Very large. The percentage of your P's and G's to the cost of the project should actually be a bit lower than if your project is low value in terms of percentage, in my opinion.
Agreed. So we're saying the same thing, that the bigger the project, the lower the percentage of P's and G's, but remembering that the bigger the project, obviously that's when you need people with CIDB 9s and above, so therefore they can come on. But then you fall into this funny no man's land, where your units are between 100 and 200, where all of a sudden you need a CIDB 8, but the P's and G's of someone who's got CIDB 8 is too much for a project of that size. And we see that a lot with some of the CBD projects, where the people the contractors that are good in the CBD don't always have CIDB, but they're the ones who can come in and do that project at a P&G of 7 or 8%. So then it becomes a challenge. Okay, so those are the things you'd see. You'd see preliminaries, you'd see escalation, we've talked about, contingency. And once again, I want to throw the cat amongst the pigeon. Often, when we do a budget, we get to a point where the cost is 530, and now what we need to raise in debt doesn't work, so we're looking to cut. It's easy to go and cut contingency. Should we do it? It'll come back to bite you. It will come back to bite you. I know developers would say, nah, go for it. But, but you know, those are things to think about. Okay. Then another thing.
May I just please have some clarity? You mentioned that SHRA takes time to pay. The risk is usually with the professional people. How long do they take to pay for the professionals? Because most of the time, then they demand their money from you as a developer if the service provider or the funder is not willing to pay them at that time. So that's why I'm interested. Thank you.
Right. So let's just break that up, because there's the period where professionals are on risk. That is before you're constructing, before you've drawn down on your CCG, right? And we talked about that period. It can be anything from 12 to 18 months. It can be faster. It's also about how you package your project, but that is something that is unavoidable, that your professionals need to give you a project design concept that is advanced enough to meet the SHRA's submission requirements, right? But then obviously once you've got your CCG, typically the problem goes away, because the drawdowns from the SHRA, if I remember correctly, it's 30 to 40 days from when you submit your drawdown invoice. So obviously it's your progress draw that your QS and your principal agent do, where they certify the works. You submit it to the project officer, then they've got 30 to 40 days to pay you. So it's a 30, 40 day cycle. But what is this also reminding us about why CIDB is important? Because of that 30 to 40 day cycle, you need contractors who aren't going to go into default if they don't get paid within 5 days. SHRA might pay you faster, but you need someone who can carry that process for 30 days, and it's not going to be in trouble. And normally CIDB 7 and above is not a problem. I don't know if I'm saying anything that's, anyone sees it differently. Yeah. Agreed. Yeah. Yeah. Yes. I agree. I agree. Yeah. Yeah. It's a challenge. Agreed. So okay.
Hi, my name is Zisanda. I'm a QS. I just wanted to ask, I wanted to take you back to what you said about the requirement to submit a BOQ while you're still in application. Firstly, I want to ask them, with the other fundings that are not necessarily for the capital cost, do those fundings cover this cost of actually getting to the stage of producing a BOQ? Reason being, I mean, this becomes too much of a risk for a QS. I mean, at this stage, you are basically at the end of stage 4, which is about 50% of your professional fees anyway. And the other element is that it becomes really tricky because the rest of the team, by that time, they should give you what is very close to what we'll call construction drawings, for you to have a comprehensive bill of quantities. Without those, while you're still working on concept designs, there'll be a lot of differences from when now you actually have construction drawings. So it becomes a risk not only to the professional team, also to you as DRA, because what you'll be getting is not necessarily the actual cost, it is an estimated cost, because we are basing it on concepts which are not necessarily developed designs. So if this is covered in other funding, then a developer or an SHI can apply and pay for the risk and get it to that level. If not, perhaps this is an area that should be looked at.
So the yeah.
I just heard of this now, and this change or this development is scary.
Yeah.
It amounts to the same Concord ruling that I mentioned in the first or second day of these workshops last week. It's scary. It's not cheap to have professionals. The QS, the point he's making, I'm pleased that you do so, because it costs for us to carry a project, on risk especially. This is what then causes that disillusionment, this irritation, this sense of saying, listen, it's not worth it.
Yeah.
Because if our very own SHI or SHRA institution or government institution is not enabling, but rather curtailing or making it a challenge for us to even knock on that door to access these funds, we may as well pack up and leave. Because that's where the bolts and nuts of it start off.
Yeah.
You may find a nice opportunity, a perfect site, a perfect location, everything checks out. But in order for you to package and submit, because that cost of bringing it to that stage is not even covered by that grant to complete the pre-feasibility. So now, how are you going to carry the cost, what? Let's say even if you peg it at 8 or 10.5%, you can even drop it to 7%. He's an aspiring developer, and he's quite upbeat about the session. But guess what? That's where the challenge lies. So the new incoming CEO or the incumbent executive structure,
Yeah.
this I make as a political statement to them directly. It's not worth it. It's not worth it if you put in place such conditions. To prepare a bill of quantities, I was preparing a program here whilst the session was happening. It's not cheap. Thank you.
Can I ask that on that point? We are noting it as something that must be raised to the SHRA, and perhaps we can move on that, having noted it as, I don't think it's just you. I think the room is saying that, and we note that.
Okay.
If it's okay, can we move on?
Yeah, and also as he mentioned that I'm still in the process of discovering this. Here am I sitting here thinking, okay, where am I going to get this money to pay for the professional services? And then something comes to my mind to say, maybe you can sell, you can give out part of the equity of your company to other professionals that would actually join you, so that you are able to, I mean, you would sit down with them and say, okay, you're an architect, let me give you 2% and let's package this thing together. At the end, it will benefit both of us, but again, it has taken from me. So what is the simplified method?
All right, so I'm going to suggest
I
that
think we need to move on.
let's move on, but we are noting it as a point that was emphasized. Okay. So, coming back to two things I want to highlight here. The VAT. So when you do your estimate, always remember that you need to have the VAT split out separately. Because when you put your numbers into the Quick Scan C, the Quick Scan C automatically adds VAT. So if you take numbers that already have VAT, you're going to get a Quick Scan C that has VAT on VAT. Okay? Then the next thing also is interest during construction. QSs often put that into their budgets. You must take numbers that don't have interest during construction because the Quick Scan C automatically adjusts for interest during construction. So be careful not to double count your numbers. Okay. So, once you've done the budget, you got it from the QS is giving you what? A total development cost. They're also going to give you a cash flow projection, which is how the cash flows are going to be drawn out during the construction period. And then what the Quick Scan C will do for you is to estimate your rentals. You're going to put in your rentals. That gives you your income. It's going to estimate your return on investment, which we talked about. It was all those things like your initial yield, your IRR, and the risk analysis. So all of that happens in the Quick Scan C. So what's important is you get your budget from your QS. They will then fill out a section of the Quick Scan C, and then you do the rest, which we're going into now. So what does this model look like? Before you even start thinking about a Quick Scan C, these are the things that you must have done. You must know your ownership structure. Are you an ODA? Are you an SHI? Remember we said ODAs is the 20% equity. SHIs don't necessarily have to have equity. And then also the SHIs, income tax is not payable, but not necessarily. Is it true that just because you're an SHI, you don't have to pay income tax? No. You have to have a tax exemption where you get registered as a PBO. If you don't have that, even though you're an SHI, you will be, you'll be due to pay tax, then you'll have to go back and sort it out. So make sure you at least have that PBO status. Then you must have a feasibility costing. And remember we said when you first apply, it's just an elemental. You don't need the BOQ. So there you need to know your land costs, your construction costs, professional fees, and the sundry costs. For your debt, you must at least have an indicative letter, which says how much debt are you borrowing, the term, the interest rate. You don't necessarily have to have the interest rate up front. That can come later on. But you must at least have a commitment that they know the project, they know where it is, they know the quantum that you want to borrow, i.e. the amount of debt. Your income sources. So you must have at least a concept that says, remember we showed you that, that table that had income band 1, 2, 3, 4, and 5, how many units you're allocating to each income band. Then obviously in your income sources, are you going to be charging rental for parking? Are you going to charge rental for shops? Your basic unit layout to say, in my income bands, am I going to have studios? What size are my studios? Am I going to have 1 bed? What size are my 1 beds? Am I going to have 2 beds? What size are my 2 beds? And how am I going to mix them up? Typically, who does that? The architects. And then the long-term maintenance plan. This catches most of us because when we hear long-term maintenance plan, we just want to put together a quick thing with the property manager, but I'm going to show you the level of detail that you have to do. Is that showing? So this is an example of a maintenance plan. You can see that it's got planned maintenance. And it also, because reactive maintenance for the most part is stuff that you do ad hoc. But you have to spell out over a 20-year period, how are you going to make improvements or repairs on slabs, the external envelope, steel windows if you have, aluminum windows if you have, external walkways, your balustrading, your roofs and rainwater gutters, etc. And then it should also have like electrical equipment, fire equipment, your lifts. So I think you can see there the level of detail. It's incredibly detailed. You can request a template like this from the SHRA to help you, but often we get caught on this one because the level of detail that we provide is not what the SHRA is looking for. Okay, so we're clear on, this is your checklist of things that you must have before you start a quick scan C. Otherwise, you won't be able to complete it. What does the model look like? What you'll see across the models that the SHRA gives you for quick scan A, quick scan B, quick scan C, they're all structured the same. Anything that has a green tab is for your attention, as in you must work there. Anything that is blue, you must pay attention to it, but you can't change anything. Anything that is gray is for the SHRA, it's not for us. Then when you're in a spreadsheet, anything that is yellow in the background means that you can change things there. You can actually do stuff. If it's not yellow, you'll see, you'll try, change stuff, and nothing will happen. I can't tell you how many times we get calls from people who say, but this quick scan C, I need to change this so that it makes more sense. It's not possible. Or they want to say, can I have the password so that I can unlock this and change this? It's not possible. It's never happened. It will never happen. It's for quick scan A, B, and C. The SHRA will not give you the password. And the main reason for that is, imagine Homoto thinks that quick scan C should work like this. Mdu thinks that it should work like this. If Mdu goes and changes, I go and change, then I give it to the SHRA. I mean, they're going to spend all their time trying to understand Mdu. Why did you do this? Homoto, why did you do it? It doesn't make sense. So we need to basically understand the model and work within what they've given us. In summary, if it's yellow, if the background is yellow, you can change it. If it's not, you can't change it. If the tab is green, it's for your attention. If it's summary like that in blue, you can see stuff there, but you can't change anything. Everything else you can ignore. So, okay, we've got 20 minutes till lunch, and I think we should keep going. Okay. So now, when you're in the quick scan C, there's 5 sections. This is just, a simplified way of thinking about it. Some people do it differently, but the first section is your project information, which is the name of your company, the name of your SHI, the location of your project. Is it a brownfield? Is it a greenfield? Are you an SHI? Are you PBO registered, etc.? Section 2 is your financial information. So, how have you raised your equity? How have you raised your debt and the terms of your debt? Section 3 is the allocation of your units between primary and secondary units, beneficiaries. Typically, your architects will help you with this section. Section 4 is just your estimates of operating costs, direct and overheads. Section 5 is the capital expenditure, the project budget, what you get from your QS. The easiest thing to do is when you get to the CapEx expenditure, send the whole model to the QS. They will know what to do, and they will fill out the budget, and they'll send it back to you. And then 5 is where you check what? Your 5 key performance indicators. So it's what you check. It's where you look to see if your model works. So let's go. Then there's other stuff in the model that you will see, but is not really applicable. Well, it doesn't really affect us. The rent quote. So all the rent quote is a measure of the rental divided by the household income. So the rule is that on average, your tenant is spending more than 33% of their income on rental. But that's on average. So you can imagine for income bands 1 and 2, the percentages are lower, whereas for 4 and 5, it's higher. But on average, it mustn't be more than 33%. Okay, short-term grant retention facility. I wish I could jump this because it's going to get us stuck again. But the short-term grant retention facility says, when you draw down from the CCG, you can draw down up to 90%. At 90%, the SHRA stops paying. Then that last 10%, they pay it as you let the building. So once again, you've got a CCG of 70 million. You will only be able to draw 63 million as progress draws while you're still building. When you get to 63, they stop paying. You need to finish the project, then you need to start bringing people into the building. As you bring people into the building, you can draw down on that 7 million outstanding. So what does that mean? The problem is your contractor is going to want their money. I mean, they're not interested in what you're going to do once, once you've finished. So you need a bridge facility. Yes, it's adding to the things that you must go and arrange. Unfortunately, that's what it is. That's why I put that disclaimer to say, I wish I could jump this because it's another challenge. But the main reason for it is to make sure that you finish the project and get it occupied. So you need to arrange a bridging facility that will help you from when you hit 90% of the CCG to when you finish it. Normally, that bridge needs to be in place for about 8 months, 8 to 10 months. Okay? So it's unfortunately, there's no ways around it. It is a requirement. But you can get the same bridge facility from the same funders we talked about, NEF, NHFC. They understand this and they will typically give you the facility. Yeah, typically 8 months max. Some funders, and I mustn't get myself in trouble here, some funders even offer this at concessionary rates where it might be like at prime -5, prime -6, because they know that it's an extra burden and it's only for a short period of time. Swap costs, wear and tear, I'm not going to get into that because it doesn't really affect us. So what we've got here are some quick videos of someone working through the model. Because then once you've seen these videos, when we come back after lunch, we start our case study and actually work in the model. So.
Hello. Hi, sorry. Quick question. For the bridge, right? So is it once the 10%, is it disbursed in an escalated manner or is it given once, completely the 10%?
Great question. So it's given in stages. So typically what will happen is once you've let your primary beneficiaries, so income bands 1 and 2, you can draw 50% of that 10%, and then the residual 50% is in stages as you let income bands 3, 4, and 5. It comes out to around, it's like a staggering of 15, 15, 10, like 15, 15, 20. But they've actually got a model for it which spreads it out. Occupation. But typically if you've got your, well, it depends on your policy that you must prove to the SHRA that the people have signed and paid deposit, which equals occupation. So they've met your letting requirements to say, when is this unit let? If that is that you have signed your lease and you've paid your deposit, then it's let. But it's a good question because sometimes someone might say, I'm applying now in Jan, but I'm moving in April. So if your letting requirement is that they must sign the lease and pay deposit, then it qualifies because they've paid the deposit, they've committed. Hey, that's actually a good point. That's a good point. That's a good point. That's a good point.
We haven't experienced it so far, but you can do that, provided, I mean, you can confirm that the whole development is fully let by signed leases and vetted tenants, and that all what the tenants are waiting for is to take occupation.
Yeah.
Look, I mean, we haven't...
if I'm just using common sense, they would probably say that, yes, you've done that, but at least from practical completion, you must prove that some of those people have physically moved in. Otherwise, you could be in a scenario where a bunch of people apply, they pay deposits, but then they never move in. Then
yeah, look, I mean, if you look at the deposit, You know, you look at your income bands. Yes, you can leverage.
Yeah. It's, yeah. Yeah. It's a, I mean, it's a,
Remember that your income that you're going to get, I mean, we haven't done this calculation, but it's not going to be close to the 10% retention. Because if you are going to be doing, let's say, 100 million, you need about what, 10 million, which will be the retention. And your deposit of those rentals, so if you take average of 3, 4, multiplied by the number of units, it's not going to be closer to maybe a tenth of that of that retention.
but
It's a good idea.
It's a good idea. And I think
Yes,
that
yeah.
maybe that just needs a bit of clarity.
Yeah.
Yeah. Okay, so we go through these videos. They're quite short. Are we good for the videos? Then the earth size, always remember, it wants you to put the earth size in hectares. So there are 10,000 square meters in a hectare. So if you've got 20,000 squares, that's 2 hectares. VAT status, we're going to get to that now. Okay, so we're comfortable. We work in 2 tabs, CapEx inputs, general inputs. Anything that's yellow in the background, we can do stuff. If it's not, you can't. So this is just showing you what was happening in that video. Your project name, project commencement date, when you start the project. This isn't when you're going to start construction. It's when you're starting, when you effectively want to say, what is our pre-tender start date? When do we start formally planning? And then the end date is obviously, the construction period is everything, pre-tender and post-tender. Okay? And then your applicant name, I won't go into all of those details. Remembering here, is it registered for VAT? Very important. Does it qualify as a PBO? That triggers whether the model is going to treat you as whether you pay tax or not, income tax. Okay. Can keep going. So remember that table we showed? We said step 1 was project information, then we said 2 was debt. So let's go into that section. Where do you get the information here? We spent a lot of time on the shareholders loans, shareholders agreement. Those documents will give you the terms of your equity. Then your debt letter or your term sheet will give you the information you need for debt. So there it says loan spread over prime. If you've got a loan of prime plus 1, you're not going to put the total interest rate. You're just putting in the spread. So if your facility is prime plus 1 and prime is 10.75, you're not going to put 11.75, you just put 1, the spread. For most projects, the loan during construction and the loan after construction is the same. So in commercial it's different sometimes. So we can just assume that the spread during construction and post-construction, you can just assume it's going to be the same. If it's plus 1, it will be plus 1. Then it gives you options for 3 loans. If you've got loans from 2 different funders, you would put in from each funder. But if it only just 1, as long as the facility size is 0, doesn't matter what you put in anyway, because it's those numbers times 0. So just make sure if you've only got 1 loan, the other 2 loans must be 0. Then the arranging fee, that's the cost that the funders charge you for arranging the debts. So do you see how all of those things you must include in your budget? Because if you include them in the budget, the Quick Scan C automatically calculates them. Value of equity, I'm going to come and spend a bit of time there because it's often confusing how we fill in the equity. Once again, the equity can be share capital or can be shareholders' loan. So what were we doing there? The first step was equity. Here in this example, I can't go past there, hey, can I? In this example, the equity was 7.9. Now, if all of that, if we said your percentage of equity in the form of shareholder loans, if you put 2%, it's going to take that number, what is it, 7.9. It's going to take 7.9 multiplied by 2%, and that's your shareholder loan. So it's assuming that the 98% left over is cash that you're putting into the business, but it's not a loan, it's cash. So how could it be different? If 100% of that 7.9 was a shareholder loan, we'd still put in the 7.9, but we'd put 100% there. Then automatically jumps you over to here, shareholder loans. And it says arranging fees. Whatever, now we're getting into those discussions around your agreements with your funder, your pref shares. What is the cost of the arranging fees? What is the margin over prime on the shareholder's loan? So whatever you agree with your preference shareholders, if you're going to pay them 15%, if you're going to pay them 20%, that as a margin over prime is what you'd fill in over there. Are we clear on that? Okay? Then you, the debt, you put in your debt there. It's very important, the facility size. If you've only got one loan, loan 2 and 3 must be 0. Then it won't affect your model. But obviously, if you've got more than one loan, you must fill them out respectively. Arranging fees for debts, typically 1 to 2% of the loan amount. Once again, you know, we're all here to learn with each other. And if I'm saying something that you don't agree with, I think if your arranging fee is more than 2%, you probably need to talk to someone in the industry, because it should be around 1 to 2%. And anything above that is a bit aggressive. Okay? Commitment fees, most banks aren't really charging these anymore. So it's basically to say that if you get a loan of 10 million, but you only draw down 8, they charge you a commitment fee on the 2. But you know, I don't think that's something we need to really worry about right now. And then, yeah, that's fine. VAT. So I'm going to spend a bit of time here, then we can go for lunch. What is VAT? I mean, the definition there, it's a value-added tax on consumption that's placed on a product whenever you add value on a product. But what drives whether you can claim VAT as a VAT vendor as a VAT vendor? What drives whether you can claim VAT? Well, firstly, yeah, you must be VAT registered. But it's the supply you provide. So it's not about what I get, it's what I provide. If I make bottles, and the supply of making bottles is VATable, then I can claim VAT. Are we agreed? If my business was purely like school, education, I think school is VAT exempt, we'll double check now. If my school is the business of schools, and that's actually not a good example. Let's take something else, like bread. That's also, wait. Let's go here first. I'm going to PDF. So here's an example here. Because some goods are 0 rated, some goods are exempted. That's why I wanted to step back on that example. Oh. Thank you. Let's go into that. So, which goods are exempt? Which goods are 0 rated? So if it's exempted, it means there is no VAT. VAT is not in the equation. It means I cannot claim VAT. But there's a nuance there. If it's 0 rated, it means there is VAT, but at 0%. There's a difference. If something is VAT exempted, it means the provision of this supply, VAT is not in the equation. Therefore, I cannot claim VAT. If something is 0 rated, VAT is in the equation, but at a 0%. Therefore, potentially, I could claim VAT. That's a discussion for another day. But that's the difference between 0 rated, because if something is 0 rated, the supply is attracting VAT at 0%. Therefore, if the supply is attracting VAT, I can claim VAT. So it's all about the supply. But if it's exempted, the supply does not attract VAT. Therefore, you can never claim VAT Hence why we highlighted that. And hence why I need to be careful about the examples, because bread, milk, all those things are just zero rated. They do attract VAT. It's just zero rated.
Claim the VAT, you need to be registered in that category. You can't buy things that you are going to use in your business. But if you are not registered in that category, like in your VAT registration certificate can come out written pastoral and agricultural things, which means when you go and buy fertilizer, you go and buy yes, diesel, no, diesel is not VAT rated. You go and buy, what is it, fodder. You actually don't pay for irrigation pipes, maybe you can pay and claim it back. So you need to be careful which category of VAT you're registered in. Because you'll go and buy this cement and all those bricks and go and say you want to claim. Yeah, or you go and buy a double cab and they say, no, in your category, you can only claim a truck or a single cab van or, yeah, those kind of things.
Okay, that's a great point. Did we say lunch is 1 or 1:30? We said 1:30, eh? I think we said 1:30. Henry, can I ask your help to just check with her? I think it's 1:30. Okay. So going back to the presentation. So what are we saying? Did we see that residential rental is exempted? So the supply is not a VAT category. Therefore, we cannot claim VAT on our business as residential rental. Very different to residential sales. So selling land, sectional title, off plan, that sale attracts VAT. Therefore, you can claim VAT. So if I'm a developer and I sell, I can charge VAT, I do charge VAT, and I claim it. Do we agree? Yes, so what I charged out, I'm going to claim back. So for example, I'm a developer, I'm selling a unit for 900,000. I'm VAT registered, so the total price is 915 would have been like 1.03 or something like that, right? It's 90 plus 45, okay? So my cost would have been 1.1 million. But the difference between the 1.1 and the 900 is VAT. So the end user pays 1.1, and then obviously I'm going to be able to claim VAT because obviously on my construction, all my contractors and all my professionals, I've paid them VAT. So I claim VAT on my expenses or my capital expenditure, but then I charge VAT on my supply. The reason I can claim my VAT on my development cost is because my supply attracts VAT. As a residential rental business, yes, I'm paying out my professionals and my contractors and I'm paying them VAT, but because my supply doesn't attract VAT, I can't claim that money back. So I'm going to stay there for 2 minutes. Okay, I'll push on, okay. So 30 minutes, and I think then at least we know when we come back, we're going straight into the model. Are we okay? Okay, so just to round up that point, because our supply doesn't attract VAT, we can't claim VAT on our expenditure. So what is our expenditure? Paying our contractor, paying the professionals. All those people charge VAT. So the VAT cost on the project budget, you can't claim it back.
And this is why if you look at your total development cost, it will include the VAT.
Throughout. Operating, development, if you're in the business of residential rental, you cannot claim VAT. No, you should, as a residential rental, think about it. Who's ever, I'm sure maybe somebody's rented a property before. Who's ever seen VAT on your rent statement? Rental does not attract VAT. So that's why I go back to, it's about the supply. What are you giving to the market? And what you're giving is exempt. Therefore, you cannot claim any VAT on what you spend.
My question is related to insurance. How come if there is damage on the property and you get the insurance payout, you can't do the input-output VAT on that money that came from insurance? Is it because it's not income, or what is the reason behind that?
You mean what? So when you do a claim and then the claim has VAT on it, what they pay out?
No, I'm saying there is money that comes into your business from the insurance, and you have payable VAT from other service providers or operating expenses, for example. You have municipality and all of that. How come you can't utilize the money that comes from insurance as your input? I don't know the difference, but why can't you use that money to then balance off the one from municipality, for example?
That's a good question. I've never.
It's not an income, it's not a trade income. It's a payout. It's an insurance payout. So unless it's a trade income, then that's when you can be able to explore whether to charge output or not, or to claim. But if it's insurance, it's a payout, it addresses whatever claim that it's not regarded as a trade income.
All right, but I mean, as you can see, the VAT question is it's a very involved one, and maybe, it's not that I don't want to give you the answers, but what we've realized is, if you are very active in the social housing sector, it's important that you get a tax opinion on how to treat your VAT. Very important. And I don't think we here can give you the answer. I mean, we've obviously gotten ideas from different people, but even the SHRA won't give you one answer, because at the end of the day, the tax accountants need to give you an opinion on how you should treat your VAT. Okay?
And you should also be careful, because sometimes the receiver can come back to you 5 years later and say, that amount, you were not supposed to have claimed it, now you need to pay back the money.
Okay, so remember we did section 1, which was the project information. Then we said section 2, which was the financing information. Now we're bringing in the QSs, where we're talking about the revenue. How do we allocate our units? But first, go and check your VAT assumptions that you are not claiming the VAT. The reason why it's also important there is if you're doing a mixed-use building, sometimes you might be buying a building that already has leases, and therefore you're going to buy the actual building as a going concern. You can claim the VAT on that, on the commercial. Because why? The provision of commercial rental is a VATable supply. So it's all about the supply. Okay? So here you're filling in the units. What's important here is there's always going to be a top row, which gets very confusing. The top row is the size of the units. Is your unit 30 squares? Is it 40 squares? Is it 45 squares? Then under that, it's the number of units. So income bands 1 and 2 stick together as primary. Then here you would say, okay, so you've got a bachelor, type 1, it's 31 squares. How many in income band 1? How many in income band 2? So that's important. Top row is the size of the unit. Then underneath, it's the number of units. Are we together? Okay. Then you come to income bands 3, 4, and 5. The top row, once again, is the size. It gets very confusing. But then underneath it is the number of units by bachelor, by 1 bed, by 3 bed, in income band 3, in income band 4, and income band 5. Then your vacancy assumption you put in over there at the bottom. Typically the model is going to come with 7%. You can change it, but most people just leave it. So then going back to this here, this is just a summary of those income bands we talked about earlier. Now, this income spread here, what does that show you? If it says there 5%, it means that 5% of your development is in income band 1. 25%, it means that 25% is in income band 2. And likewise, 25, 30, and 15. So they've changed it now because previously income band 5 used to be 30% of the building, but now they've moved it to 15%.
Why did they do the change? Did they see that it's more feasible to decrease the income band 5? Or, because I remember doing some numbers there, and when the income band 5 was 30%, you get more sort of revenue income, yeah. Now it's 15%, which means it's the smaller units where you charge less, but then you have more of them. How do you then balance that? How do you...
Yeah.
Why did they change it is my question, I suppose.
Obviously, it was it was through a process of industry consultation, adjusting for what's happening in the market, but also household incomes. The household incomes had moved upwards, right? So a lot of projects had a problem where, because the cutoff was 15,000, you had a lot of people who wanted to apply for income band 5, but they don't qualify because they earn 16,000 or they earn 17,000. So they had to move that up. And then in accordance with that whole thing of, with the whole idea that the rent quote, what you spend on rent should be around 30 to 35% of your household income. That's how then they arrive at those bands for the rentals. However, let's think about it practically. In the past, income band 5 was on average 4,800. Now income band 4 is 4,300. So they haven't really reduced your ability to earn strong income, because that's made up of 30% in income band 4, which is at 4,003, and 15% in income band 5. So I don't know if that, and also you can push income band 4 to 4,950, which is more than what income band 5 used to be. So there's that. Yeah, income band 4 used to be 20%. 5 was 30%. So where you generate, so does everyone understand it, that in social housing, where you, as a SHR and ODA, where you generate most money is income bands 4 and 5. Because those are the units that are not subsidized. Well, they are, but not really subsidized. And in the past, income band 5 used to be 30%. Now it's been dropped to 15%. But they've increased the percentage of income band 4, and they've increased the rent you can charge for income band 5. But also it's experience. Income band 5 is difficult to let. Yes. It's very, very difficult.
Because you are competing with your affordable rentals.
Thank you so much for that comment. It's been in my mind for quite a bit, that usually if you have apartments with less expensive, usually even if you get your vacancies right at that higher brand, higher bracket, but you do get defaults, a lot of people that do not pay at that level. Yeah. So it's generally a high risk, and that also led me to wanting to ask, is the eviction laws the same way in social housing as they are in all the other apartment blocks?
Yeah, well, I guess social housing at the end of the day still falls under normal rental housing, the Rental Housing Act. So it still has to subscribe to it. However, you have to have a tenant management policy and procedure, which basically talks about your process on how you manage non-payment, and obviously getting to eviction is the last step. But you're still in social housing subject to the Rental Housing Act.
Is it prescriptive that we should go into those percentages on the income spread? Yeah. I can't choose that because the area that I'm in is mostly, for example, if there's a lot of younger people, yeah, then I'll go for more one bedrooms. I would not be allowed to make it 80% one bedrooms instead of the two bedrooms.
So remembering that the income bands talk about the rent and the household income. They don't necessarily talk to the type of unit. The two are tied. You know, often you find that when people design the units, they try to, and they shouldn't, and I have to say this, I know that a lot of us, well, you might get pushback, but you are not supposed to be in a position where all your studios go to income band 1 and 2. You're not supposed to do that. You're supposed to mix it up between, there must be some 2 beds in income bands 1 and 2, there must be some 1 beds in income band 1 and 2, and you must split, so it must be a mixed allocation of unit typology across the income bands.
Okay.
What you can't change is income bands 1 and 2, there must be 30% of your building. That's a key performance indicator. You can't change that. We've had many questions on whether those percentages can be changed. As it stands, you can't. But my advice to you is if, for whatever reason, your market study says that there's no chance of letting income band 5 engage the SHRA. And you know, that will be driven with the support of your market study, but as it stands, you can't change that. Okay, so are we all comfortable that this top row here is the number of units? So when you say 35 there, there's 35 1-beds type 1. Are we okay with that? Okay, let me come also for this side of the group. The top row, when you say 40 there, that's 40 units of 2-bedroom type 1. I mean 40 square meters, not size. That's the size, not the, see what I mean? It gets so confusing. The top row is the size. So that's 40 square meters of 2 bedrooms. Then we haven't put in the number there. A good example here is, that would have been income bands 3, 4, and 5. Therefore, there you've got 35 square meters. Okay, I can't come. And you've got 25 of them. Do we agree there? Are we together? So you've got 1 beds that are 35 square meters, and you've got 25 of them in income band 3. It does get very confusing. Just remember, top row is size, then the number of units. And if you are correct, everything goes green. But what do you notice about that? Those numbers, percentages tied to the income spread. So if anything is red, means something's gone wrong and you need to go back to the drawing board. Almost there, almost there. What's important? You need a split of 30 to 70%, and there's a good example. It's just really talking back to the income spread.
Thank you. If maybe you can go back to your previous slide. If we have to go with the income bands only and not the typology, doesn't this then give us the problem of people, a person is on a 35 square meter but paying the same amount as the other one, and then there are problems? How do we deal with that? Because I hear your emphasis that we need to mix and make sure that somehow everyone gets something that is the same or whatever. Yes. But that's a challenge.
It is a challenge.
That is the income.
But typically it's all about, one, it's about how you do your leasing process, where you explain to your tenants that your application is based on your household income. But then some developers go into a differentiation by spec. So what they will do is the finishes, the kitchen tops might be slightly different. Maybe in some units you just get a kitchen counter which is Formica. Some you get a kitchen counter which is granite and overhead cupboards. So they play around with the spec of the unit, but within a typology. So you cannot just say, because you're income band 1, you get a studio only. You have to give different options. But they play around with the specification. Okay? So this is just further illustrating that point, that the unit size, that arrow should be pointing at the 30, and the number of units is the 25. And then you come down here, now that's unit size, then the number of units for income band 1, for 3, 4, and 5. Okay, are we comfortable? But when we do the example, it's going to get very clear. Then the weighted average rent quote. You can see those rent quotes. At income band 1, it's 25. Income band 2 is 27. Now, sometimes we are asked, the SHRA gives me a rental band. It says that can I come closer? My upper band is, for income band 1, I can rent between 1,008 and 3,005. You do your market study, and it comes out that actually for income band 1, you could rent maybe at, say, 1,001. How do you change that? It's adjusted on the rent quote. When you move the rent quote, it moves around this target rental. If you move the rent quote to 29%, that average rental would go higher. For the most part, we shouldn't do that unless you can support it with your market study. But your rent quote is what drives the rentals. But whatever you do there, that number there cannot exceed 33%, or else you fail. It won't work. And then your vacancy, that's where you put it in. Okay, operating costs, this one's quite straightforward. Looks like we've lost sound. So when you get to step 4 now, your operating costs, remember, and then there's sections there to put in parking, rental, and commercial income. We'll show it when you're doing the practical example. But there's 2 sections. There's a section for direct cost and a section for indirect cost. Unfortunately, because you can't change rows and add stuff, you have to fit your costs into these assumptions here. Now, remembering that originally this model was built for SHIs, and a lot of the SHIs at the time were doing the property management themselves. So there's a lot of line items here that if you are doing property management, they make sense, but if you are outsourcing it, they're not applicable. So then just ignore them. And then the model also doesn't have a line item for property management fee, so you must add it yourself under direct costs. Okay? And then the maintenance, you get your maintenance costs from your maintenance plan. So obviously you show that 20-year maintenance plan, and it's got items for electricity, lifts, etc., and you need to take those costs and fit them in under those line items for maintenance over there. Okay? But then also remembering, this section of the model is annual. So a lot of times when we budget, we think monthly. So you must turn those monthly costs into annual and fill them out. And then those are VAT inclusive, whereas CapEx inputs was VAT exclusive. Must include VAT and it must be annual. Operating costs and operating costs direct and overheads, VAT inclusive, annual. Capital expenditure, VAT exclusive. And then also careful not to duplicate common area costs in your operating cost section, because it can't duplicate, and I'll show you where. Right. So this was redefining operating costs and overheads. We've touched on that a lot. And then our direct operating expenses, you can see there it's got line items, annual costs per unit, VAT inclusive. So whatever you put in, VAT inclusive. But remember, these numbers are not per unit. It calculates per unit. What you put in here in the yellow is for the total building. Then it's got these line items here, repairs, maintenance, equipment, electrical, plumbing, paint, gardens, lifts. All of that comes from your maintenance plan. Unfortunately, they've given you finite line items, so you need to make it fit within what they've given you here. And then here, it's got a line item for water and electricity common area. There's another section at the bottom where you have to put in your utilities. So be careful not to duplicate, because otherwise you're going to put in 200,000 here, then you're going to say, my water and electricity utilities is 1 million, but I'm recovering only 80% of that, so you've double. So it means that your common areas are the 200. Now you've double counted it. So be careful of that. And typically what we find is if you're outsourcing property management, you must fill it in here. So it's yellow, which means you can change it. Overheads, same thing. Once again, a lot of this stuff was designed for SHIs which manage everything in-house. So if you don't have any of these costs, you can ignore them. But remembering which KPI, operating cost per unit per month must be 1,350 per month. Okay? And then this is, we're almost, let's just do this one and then we'll break. I don't know what's happened to the sound. So we said the capital expenditure goes into the CapEx inputs. There we say, and then it's a cash flow profile, which matches your feasibility cost. But, and then, you know, based on what you said your construction period is, you would then fill out these cells over here. It's going monthly for the whole construction period. Guaranteed, the best way to do this is send it to your QS, they send it back, and you move from there. So what are we showing there? The data is taken from the quantity surveyor, and it sets out monthly your project program, typically between 8 to 12 months. Values should be excluding VAT. It does have a section if you are earning income during construction. At the bottom, it has a section for revenue during construction, so just be aware of that. And then, let's just do this one, and then we go. So remember now, we've done the 5 sections. What was section number 6? Summary. Where we... Oh, so if you've got a mixed-use building, and you've already, maybe you bought the building and you're redeveloping it, typically the shops on ground, they can still trade. You have to play around a bit, but you can still earn income during construction. Yep. Well, let me put it like this. I think it's very common that some buildings only get to final completion like 4 or 5 months after PC. It's not always that it's like a month before. So typically then PC and occupation becomes normal letting now because you're getting people in, they're occupied. It's complete, yeah. So does everyone know practical completion is you finish the building, it's essentially fit for purpose. Final completion is you've ticked off all the snags, you've addressed them, and everything's done now. But people can typically move in after practical completion if you have an occupancy certificate. That's what triggers it. I think actually the SHRA's reporting does allow for sectional handover. Whether you would consider that income during construction, I'd have to check that, but I don't think so. I think it's normal income because your project would have been a project that's designed for sectional handover, right? That if you've got, say, 6 blocks, and then you're planning to hand over blocks 1 and 2 at a stage, income on blocks 1 and 2 is occupancy income because you've met practical completion and you've got an occupancy certificate for it. I mean, we'd have to check that, but I don't think you would include it as income during construction. Let's just do this video quickly, then we go to lunch. So, what were the key performance indicators? Minimum 30% primary beneficiaries. Debt service cover ratio 1.3. IRR prime plus 4.5. Maintenance reserve must be 1.02% of the total development budget. There's an error there that sometimes comes up about facility exceeded, but we'll get to that now. Where would we go check our KPIs? Under the summary tab. And it's blue, so can we change anything there? No, it's blue. Okay? And we see at the top, it's got sources of income and sources of funds and uses of funds. Source of funds is where does the capital come from? Use of funds, under what we were talking about earlier, use of funds is employment of capital. So what did we use the capital for? Okay? And then I'll explain this one just now. The 5 KPIs are at the bottom left hand of the sheet. So you can see there, the first one is 30 other units, 30% primary beneficiaries, then the debt service cover ratios, then the IRR, maintenance reserve. So you check those all on this sheet. If anything, if it's got a green tick, you've done well. If anything doesn't have a green tick, you've got a problem. So I think we're good to go to lunch there. Then when we come back, we do the case study.
So what we're going to do for the case study, we're going to put you in
Guys, shall we get started? As Henry was saying, if possible, let's try arrange ourselves in groups around anyone who has a laptop. So groups of 4 or 5.
So
Okay. All-star team, ne? Are you guys going to win it? You guys are also prepared. Are you ready? Good. Are you prepared? I'm saying you guys must decide for yourselves. Yeah. Les chapeautins. Okay, so shall we start reading through the case study and see what we have to do? So firstly, did everybody get the email with the quick scan C? You didn't get it. Which group doesn't have the quick scan C model? It was emailed yesterday. So in the email, you didn't get it? Okay. Okay, so let's get going. So you should have received an email with a couple of attachments. If you didn't, Henry has a flash drive that he's handing around. Okay. So let's read this case study. You have been appointed by startup developers to assist in compiling their QuickScan C model. Okay. Startup has secured a land parcel in the Joburg CBD to develop a social housing project. The project will be a refurbishment of an existing building from commercial to residential. So this should be triggering some of the stuff that we went through, that remember under project information, you had to put in whether it was greenfields, whether it's a refurbishment. Let's think about that. The building consists of 5 stories situated on a 5,000 square meter stand. Are the bells going off now? Remember the land extent,
Hectares.
which will be converted to residential units only. No commercial uses will be incorporated into the development. So no commercial. Given that the project is only residential use, the parking available will not be charged for. Okay. Startup Developers is a new company formed for the purpose of developing this project. They intend to apply under the other delivery agent program. The company is not VAT registered. So we're obviously getting a lot of information there. They have provided you with the following information to aid you. Company name, Startup Developers Pty Limited. Project location, the Joburg CBD. Project name, ABC House. VAT status, NA. Land size, 5,000 squares. Start date, from land transfer date, 1st of January 2020. The QS costing is provided as an attachment. Pre-tender, 2 months, contract period, 11 months, construction period, 13 months. Bells should be going off there. The QS has also provided a cash flow profile to aid in completion of the model. That's one of those attachments that we gave you. It should say cash flow profile. Number of units to be developed, 100. Unit configuration, there's 20 units per floor. So studios, they're 30 square meters in size. There's 1 studio per floor, and there's a total of 5 because it's a 5-story building. 1 beds, there's a typology that's 32 squares. There's 5 per floor, so if there's 5 floors, how many is that? 25. And so on with the 2 beds. Vacancies expected at 8%. Operating costs and overheads, you are provided with a schedule of expected direct and direct operating costs and overheads. Be careful, some are given as annual, whereas some are given as monthly. So did we talk about that? The quick scan C must always be annual. All units will have prepaid electricity and water meters. It is expected that 100% of the metered utilities will be recovered. However, provision for common area water and electricity is provided for. So have a try in that. If you're having any problems, ask me and Henry will show you, will guide you a little bit on that because we actually didn't touch on that today. Financing structure, equity contribution, 9.5 million. Equity contribution to be provided as shareholder loans. So we talked about this. This equity is 100% shareholder loans. Then we give the details of the shareholder loans there. The loan term 10 years, interest rate prime +3, arranging fees, moratorium, senior loan, we give some of the details there. The project cost, it's given as an attachment, operating costs given as an attachment. So, based on that, let's have a try. You should have 2 quick scan C, a blank one and one that is the solution. Don't use the solution. No cheating, and we'll know if you cheat. We'll know, because there's some booby traps. There are booby traps, I'll know. So, if you're looking at your quick scan C under CapEx inputs, that's what it should look like. It should be blank. Under general inputs, there will be some figures that are populated. You have to delete everything and start from scratch. Because, for example, your XYZ, no, you must delete all of that, start from scratch. That 15 million, you must delete it, start from scratch. All right. Any questions? It's 20 to 3. I think we all want to go home. What time do we want to go home? 3:30, 45 minutes. Let's see how far we get. 45 minutes, let's go. You'll know tomorrow. Tip for everybody, start with project information. Tip to everybody, start with information, get that right. Then move to everybody, under project information, there's a section there that combined and then background, so you can't change it. Cost of land will update it.
Including number of units.
And then the number of units will update when you do revenue. So when you fill in revenue, section 3. Okay? So you can't units. Oh, was I cutting off? Okay, so under project information, there's a section that says number of units and cost of land. Because it's not yellow, you can't change it. Cost of land will update when you do CapEx inputs. When you put in your budget, the land cost goes in there and it will update. Number of units will update when you do section 3, the revenue. So when you start allocating your units, automatically it will update. So remember, if it's not yellow background, you can't change it.
I know this.
So guys, another question that's come up. Under CapEx inputs, the cash flows that we gave you from your QS, you will see that they don't have contingency. The reason we left that out is under Quick Scan C, under CapEx inputs, there's a specific area where you put in what the contingency percentage is. So you must still fill that in. If it's going to be 5%, 2%, so we left that out so that you must put in. I would just leave it as whatever's in the model there. If the model says 5%, leave it as 5%. Yes. Oh, I gave you. So there's a question here. Under equity, you'll see that hurdle rate. Which there's also prime spread for shareholder loans, so spread above prime. The spread of prime that we've given you applies to shareholder loans, and this is a shareholder loan, so we only populate that side. Where it's hurdle rates, that would have been if your investment was not a shareholder loan, but just cash equity. So for this exercise, you can just ignore the hurdle rate.
So we ignore equity side.
You ignore the equity side because your whole equity.
Confusing because and that's nine, and then that is the terms of the shareholder loan, but we can't put in all our equity.
No to hurdle rate. Okay, guys, it's 3 o'clock. Let's go. So, can I get a sense of, is everybody at least done with project information? Project information. Is everybody on financing now? Financing, okay. Isaac? Oh, I'm not cutting out. Okay. So, 2 seconds, everybody. There was a good question over there to say, we didn't tell you how to allocate the units into income bands. But there's a clue there. Remember we said the allocation of units is based on what? The income spread. Do you remember there was income band, 1 was 5%, 2 was 25, and so on. Look at the way the units are set out. The clue's over there. So we haven't told you how to do it, but we gave you a clue. So is everybody getting that clue about how income spread? Guys, remember this is a competition. It's 10 past. 10 past. Can I answer it for everybody? So there's another good question here that says the interest rate on senior loan is prime plus 1. But in the model, you have interest during construction and interest before construction. Remember we said for these loans, we just assume it's the same. So both of them will be prime plus 1. Just assume it's the same. Ten past, 20 minutes to go. 20 minutes. Okay, 15 minutes to go, 15 minutes. Okay, can we get a show of hands? Is everybody on section 3, revenue? Section 3, allocating the units to the flats. Okay, are we on section 3? So we didn't give you anything on grant retention funding, so you can just ignore it for now.
Or take everything out or just ignore it?
Just ignore it, yeah. Pressure, pressure, pressure. There's a group that's already on CapEx inputs. Pressure, pressure. Hey. Pressure is up. Another group is on capex inputs. The pressure. So, guys, capex inputs, remember what we said. Your capex inputs you would send to your QS. So when you're copying it across, don't copy it line for line. We've given you the answers. Just select all of it, copy, paste. Operating costs, the same. We've given you a schedule, copy them across, paste. I wouldn't type out one for one. You don't have enough time. We've got 10 minutes left and then we're done. 10 minutes left. Guys, did you hear that? Capex inputs, don't type everything out. Just select, copy, paste. Operating costs, select, copy, paste. 10 minutes left. For this exercise, depreciation, working capital, ignore them. We're not doing anything there. So guys, swaps and all of that for this one, just ignore them. What did we say that the trick is with operating costs? Some of them we gave you as monthly, but what do you have to do? Multiply by 12. Everything must be annual. Then you can copy it and paste it. Exactly. Okay, 5 minutes to go. So everybody, we are going to cut it off at past. So 5 minutes to go. Working capital, depreciation, just ignore those. Move on. Guys, capital depreciation, ignore. Move on. Okay.
Right.
5 minutes left. Three minutes to go. You shouldn't say that. Yes. It's left. 2 minutes left.
Do we have operating costs?
It shouldn't be inputs, it's not there. Checking CapEx inputs. No, so that spreadsheet that you got. If it's not there, then copy what's in that spreadsheet.
All right.
Henry? I think, guys, that's it. Time is up. That's it, guys. Time is up. Well done. Well done. Well done. That was a great effort, but I think everybody, most people, operating costs. No? Okay. All right, guys. Well done. Well done. Great effort. Very great effort. Well done, guys. Well done. Okay, shall we close up? Okay, we've given you the solution. The solution is in a spreadsheet with the solution. There's a small differences in the solution because we just wanted to see whether people copied from the solution. But in general, the solution is going to give you all the right answers. So that was it. So let's talk about it. What did we learn? What did we learn? It's tough. It's tough. Yes. What did we learn? No, let's talk about it. What did we learn, guys? Let's share. Please share your learnings.
It's not easy.
Here we go.
How did you know? No, it's fine. How did you know how many sheets? Because they don't give me that.
Remember, it came in as a shareholder loan. So the money, the equity, came in as a shareholder loan. So we say there, we say basically the equity contribution to be provided as shareholder loan. So it's 100% of the equity comes in as shareholder loan.
You know why we were confused? She's saying that means then I don't have any percentage for the building if the shareholders are giving 100%.
Oh, okay. Oh, okay. Where do we ask how many shares? Oh.
Because if it says 100, that's what also how I understood that the shareholders gave the 100% loan. So also understanding the question, does it mean I don't have percentage because the shareholders gave the 100% loan?
But you know why that's important to understand? Everybody was asking this thing about how do ODAs raise money? Because even ODAs often don't have 20% equity. So it's possible that as an ODA, I can raise 100% of my equity contribution as a preference share or a mezzanine loan. So that's what we were trying to show you there. It's not about the number of shares, it's about how are we raising our 20%. So if I'm so I would have, if you're the ODA, you then go to National Empowerment Fund and you say, National Empowerment Fund, give me an equity loan that's equal to my 100% of my equity that I need for this project. That's what that's doing. Is that clear? Well, no, it's just about your mezzanine or your preference shares. Sometimes it could be a shareholder, but that's effective. Does that make sense? Okay.
So that means, let's say the amount that you need, let's say it's 100 million,
Yeah.
the total value of the total
Project.
cost of the project. Now you need 20 million.
Correct.
That is the 20%. And then you're going to have 10% scenario. The other 10%. The other 10% as shareholders.
20, yeah.
Right?
So it's 20 as the shareholders.
You have 20, right? Total amount that you're supposed to contribute.
Equity.
Equity. Oh, okay. Then if you have 5 and you contribute on that one, and then like 20%.
I would think about it will get confusing if you think about it like that. The point here is you need to contribute 20 million out of million. If you had cash, you would put it in as cash. You can go to National Empowerment Fund and say, we want to borrow 20 million from you. And you borrow that 20 million. To do that, you'd fill it in like that, where 100% of that equity is what? A shareholder loan. The price of that shareholder loan that NEF would give you would be that margin over prime. So that's what it's doing.
I understand. What if then you've got, coming to her example, you get 20, but then you've got 10 from somewhere, I mean, you also get 10 from somewhere. How do you then calculate it here?
That's a challenge because the model only allows you to fill in one shareholder loan. So you'd have to find a way to customize, to say, maybe your loan was at prime plus 2, yours was at prime plus 1, therefore I'm going to put in prime plus 1.5 or something. You have, because the model, it doesn't cater for that. See, the model's not perfect. It's not perfect. Or maybe you just put in one of the shareholder loans. Actually, I'm answering my own question. You would put in the most expensive one, because that's the worst case. So if you came in at 10, you came in at 10, yours was prime plus 2, yours is prime plus 1, you put in 20 prime plus 2, because that's showing the worst case. You see what I mean? So in the worst case cash flow. Does that make sense?
But when you do that, does it then show a true reflection of your equities?
No, but remembering that the QuickScan C is the SHRA's model. You as a developer must have your own model that talks to the QuickScan C. Okay. All right. So, how are we feeling?
No, you need to run through this thing one by one.
Okay, so we don't have enough time to run through it one by one. Okay? Must I
No,
turn
not the
this?
top part.
Yeah.
But when it starts with the numbers.
Yeah.
Let's go to the numbers.
Okay, okay.
This part, one type 2, that was challenging.
That was challenging. Okay, so I think we're getting a request. Isaac, can we load it up? All right, given time, let's just do. Oh, sorry. Ah, it's off.
So my question is, you see on the distribution of the units,
Yes.
I think that's where almost everyone is stuck.
Yes.
Because we don't know how to do it.
Yes.
So my question based on that is that why is the QSC not addressing the fact that your unit distribution, it is not just based on the size, it is also contributed to by the AMA finishes. Like
Yes.
for an example, I can be any 22 and then maybe I stay in a budget.
Yes.
It's the same thing that we've been talking about.
Yes. Okay, can I answer that question? Can we go through the exercise, not the solution, but do it together for, we can't do the whole model. Let's just do the unit allocations. Okay. Okay, so I don't have, okay, so I don't have the data in front of me, so I'm going to need you to help me. But remembering that the first thing that drives our unit allocations is the income spread. 5% of our units must be income band 1. 25 must be income band 2. 25 income band 3. 30% must be income band 4. and 15% must be income band 1. Now, agreeing that because this is a difficult exercise, and normally you are required that you must mix up your units. You must have 2 beds, you must have 1 bed, but because this is difficult, we simplified it. That's where you got stuck, okay. All right. So, as a start, we must go and remove any of the existing data. We remove it. So who can help me? How many we had? What's our first typology in the list there? Studio, how many studios do we have? 5. So we go to our income band spread and we said typically income band 1 would have been 5%, so and there's 100 units here. So 5 over 100 is 5%. So we come here and the studio, what's the size of the studio? 30, income band 1, we've got 5. Okay. Then what comes next? And I'm saying we've simplified it as per the income spread, just so that you can literally look at the income spread, then go and fill it out. Okay, let's move over to 1 beds. What's the next 1 bed? 32. So what is that tied to? It ties to income band 2. Okay, and was it a 1 bed or a studio? There were 25. And the size was 32. So we agree then we finish with primary beneficiaries. Okay, then we go to secondary beneficiaries. All right. What's the next unit that we had? It was a 1 bed. The size was 35. How many? 25. It ties to the income spread. Then we go to income band 4. What was next? It was a 2 bed. How big was it? 40. How many? 30. Then we go to the next one. What's the size? 45 squares. How many did we have? 1, 5. Okay. And there we go, we're green. So there's the green. So we simplified it for you. Did you guys get it? Well done. So you got it. Great. Great, great. Okay, so let's move on. Let's wrap up. There's one little thing I want to show you. If you could just pay attention, I just want to show you one thing. This is something that we've only recently realized is a problem, where, a couple of applicants, they did the quick scan C and SHRA's happy, everything works. Then they send their model to NHFC. But then NHFC says, no, but guys, your costs are too high. And you guys, in your model, you've got costs of, let's say, 1,350. What's causing that? Just something so you're aware. So who got down to this section here under utilities, utility forecast? Did any of you get there? Okay, so here, what the model needs you to do is to estimate your utilities, electricity, water, refuse, effluent. Who remembers where I said don't double count common area costs? So you're going to put in all these utilities, it's R1 million, right? But then you say utility cost recovery rate, 100%. What that's saying is that R1 million, you're recovering it from your tenants, okay? So if I change that number to 80%, it means that of that million, I'm only recovering 800,000. So where's the other 200,000? It's common areas. It's what I'm not recovering. So if you do that, do not then go and put in, there's an area under direct costs. There's this line here, water and electricity, common areas, because then you're double counting, okay? Then there's another problem where, well, not a problem, but there's nothing we've discovered. What happens is, let's say we had put in that 100%. So that R1 million, would you agree that if I'm recovering it from my tenants, it's not my direct operating cost? Because I'm spending R1 million, but I'm getting R1 million, so it's 0. All right. Now what happens is, when you send your model to the funder, NHFC, so anyone who's not SHRA, so I'm not saying SHRA does this, but funders do this. You've done this, you send it to them. What they go and do, they come here. So do you see where I am? I'm just below that utility section here under operating cost summary. Can everyone see that? They will, because remember someone asked me about models and that this model is not representing things clearly. Everybody has their own financial model. NEF will have one, DBSA will have one, NHFC has one. When NHFC does their model, they say, what are the operating costs on this project? And they will go straight here and they'll pull this number, 1266. What's wrong there? Can you see? So in that 1266, let's actually use this. Is this the solution? No, that's blank. Let's use the solution so that it's a better illustration. There's a better illustration. So they will come here and they will say, you see, direct total forecast, direct operating cost, 1.5 million. Total forecast utilities, 700,000. Where does that 700,000 come from? It's these costs here. Do you see that? Right. But we've said these costs are 100% recoverable. So they're not a true cost. So then what's going to happen is they're going to come back and say to you, your direct operating costs are 2.3 million plus your overheads, you've got total cost of 2.47 million. But in truth, it's 2.7 minus 700. So you'll find your numbers don't work. They work in the quick scan C, but your funders numbers don't work. NHFC's numbers don't work. So do you understand that? So always make sure you are communicating to them that they must please ensure that they check what assumptions you've put in for your utilities. So for example, if you had put 80%, then yes, some of that 744, 20% of that must be there. I can promise you how many times we get people who are like, NHFC says my model doesn't work, but it works for SHRA. This is what's causing the problem. Are we together? Okay, so let's round up. Wait, let me check. Does everyone understand that problem? Okay. So you know, it's a fair question, but also understanding that people change in organizations. And something like this, you can see how it's such a small little thing that if you aren't aware of it, you won't know about it. So instead of arguing, let's just help. Fair question. All right, so let's wrap up our presentation. What's that? Sure. Yes. Yes.
Adverse variance or differences between them.
Yeah.
So I've just spotted one now. You've made a nice example when you say NHFC may say it works. However, SHRA says it does not work, or the vice versa.
Yeah.
So,
yeah, sure.
So I've just opened my spreadsheet, my typical financial modeling. That's how we would normally do it.
Yeah.
Okay. So which I'll share just now with my group. Because what I'm picking up now is how you, or what is defined to being what is allocated under the VAT bracket or tax bracket and so forth in terms of assumptions being made.
Yeah.
For example, the point that you just made now, zero tax items and so forth, because that does create a big difference insofar as what becomes the final number.
Yes.
Okay. I'll share that with the group now so that at least they can then also appreciate what that rationale it implies.
Yeah.
Thanks.
So can can I maybe just outline to the group what he's saying, if I understand you correctly? We spent a lot of time on, you're talking about VAT, ne? Talking about VAT. We spent a lot of time on VAT for a reason. You can imagine, if your model assumes you are claiming the VAT versus if you're not, VAT is 15%. So that's either your cost is going to be lower by 15% or it's going to be higher by 15%. It's a huge difference. The base case in our models should be that we are not claiming the VAT. Should you believe you will be able to claim the VAT, remember what we said, the SHRA will direct you to get a tax opinion and then you can proceed. As long as you've got a tax opinion that can support that, because if you don't have it, the SARS might come back and ask you for that money. But what Hotar is saying is that number is a big difference. 15% is a huge swing. ODA, SHRs. Yes, yes, yes. That's a brilliant question. And I'm going to ask that we not go down there because it's a bit of a rabbit hole. But, but there is a world where a PTY can be a SHI. How do you do that? You would register as a PTY, but remembering that whether you're a PTY or an MPO, you're still governed by the Companies Act. So therefore, you would then change your memorandum of incorporation to say that this PTY will be for not-profit. That achieves the same thing. Then as a PTY, you could then go and register as a PBO. But it's the same thing because in your MOI, it says you will not declare profit. So you are behaving and you live and act and breathe like an MPO. It's a rabbit hole, so let's not go into it. But no. So if you change your MOI, that you will not declare profit and you will be for not profit, you are behaving and you've structured just like an NPO. Okay, I wasn't aware of that. Okay. Thank you. But who's got the mic? Okay. Let's give it to her. Okay, so guys, we're going to take that comment and then we're going to move on. It's the lady there.
Should I repeat what I said? Oh, okay. Okay. So I don't want us to dwell on the issue of PBO, VAT, and all that, because even with an NPC, so you would apply for that status of PBO, but still you'll be exempted. Remember, you're a non-profit company. Yeah. You're not an NGO. You'll be exempted 60%, which will be deemed that you're doing non-profit activities. And the 40% would be for profit. Because the concept around NPC is to promote social entrepreneurship.
Okay. Thank you. I wasn't aware of that.
Thank you for that comment. You know, like what we said, you know, we are here to learn, to unlearn, and to relearn.
So I'm gonna move on, guys. And I think these are things that maybe even over the next, between this afternoon and tomorrow, some of us we can engage. But let's finish this presentation so that we can let everybody go. So in summary, what were you looking for? If we had finished, and I think there were one or two groups that were very close. If you had finished, what were you going to see under, where would you find this? Under the summary page. So under summary page, if you had a tick, it's good. If it's crossed, it's not good. First KPI, at least 30% primary beneficiaries. So these tables are on your model on the left-hand side at the bottom, under summary page. Then average monthly residential operating cost, it's that line over there. It must be 1,000, the model allows you to do 1,300, but the requirement is 1,350 for ODAs, and typically for SHIs it's 1,600. But the minimum is 1,003. Your maintenance as a percentage of capital cost must be 1.02%. Your project IRR must be prime plus 4.5, which is 15.25, and your debt service cover ratio must be 1.3. What we've given you there are notes as to if you've got a problem, where do you go and look? Okay, so if your primary beneficiaries are not 30%, it's what we just did. It's your unit allocation. You go and double check that. Okay? If your monthly residential operating costs are not getting a tick, what do you check? Review your direct operating costs and overheads under general inputs, and you review your total construction costs. Why did we put that in there, Henry? Do you remember? Right. Yes, because it's circular. Yes, yes. So what we're saying is, because the big part of your maintenance cost includes your maintenance provisions, and your maintenance provisions are driven by the 1.02%. So the higher the cost of your project, the higher that 1.2 is, the more it affects the 1,300. So it's a bit circular. Then the 1.2% reserve, you review your maintenance costs and you review your total construction costs because the two work together. Project IRR, the hardest to fix because it's affected by operating income, which is your rentals. Then that's also affected by your expenses, your operating costs. It's affected by the total construction cost of the project, your land cost, what it costs you to build it, and also the terms of your debt and your equity. So pretty much IRR is driven by everything. And what you'll find is if you fix everything else, you get very close to fixing IRR. Debt service cover ratio, also affected by everything. So when you've got a problem, I would typically say, start fixing the first three, and then move on to debt service cover ratio. By fixing debt service cover ratio, it will fix the IRR, pretty much. And so that's quick scan C. That's, it took us a long time. It's 4 o'clock. How are we feeling?
What it needs is
with experience. Yeah. So can I make an appeal to the group? Please, guys, I know it's Thursday. No Pooza Thursday tonight. Please. Tomorrow is quick scan A, and I think it's going to be a short day. Hey, Henry? Short day, so hopefully we'll finish by 1 o'clock, if not earlier. But you need to concentrate for quick scan A. And quick scan A is not doable if we're not together. So we can't have, we'll be together. Okay. All right. All right. See you tomorrow.